Okay, ladies and gentlemen, distinguished guests and representatives of the European institutions here at Brussels, it is my pleasure to welcome you all, also on behalf of our Minister for European and Federal Affairs, Manfred Penz, here in our representation of the state of Hesse to the European Union. It's a great pleasure to see you all here. And of course, for me as the Minister of Finance of the state of Hesse, it is an extremely interesting topic. And nevertheless, I have to beg your pardon that I can only open this conference and will have to leave afterwards because, some more appointments and I have to go back to Wiesbaden quite early. But we had a great evening already. I recognize some of the faces here. Dear Professor Gortsos, wonderful, nice to see you again. It is an extremely important topic, and so be assured that there are some people from my ministry here, and they will stay and they will listen and take records, and so we are very interested in the exchange of ideas on the regulation of the financial markets that we are supposed to promote and to foster through this conference. I may in particular welcome and will soon hand the floor to him, Dr. Thomas Gstädtner, as the president of the EBI. That is the institution that is basically co-hosting. Well, they are in fact organizing the conference. We are just providing the venue. But they are organizing this conference, and thereby they are on the best way of fulfilling their mission. Because EBI, as Thomas Gstädtner will probably present to you in detail, is an institution we are very proud of. It's based in Frankfurt, and the state of Hesse is the sole institutional member in the board of the EBI, but there are many universities and academic institutions which have built a network through EBI in the major or at the place of the major financial hub of the Federal Republic of Germany. And so it's a forum for the exchange of ideas. It's a forum for academic work and also academic networking. And I think this has already yielded a lot of fruitful results in terms of, influencing financial market regulation. And they will certainly continue to do so. And this conference is supposed to be an important contribution to that. The topic in detail is simplification, or as it is put here, well, it's not put here, but it has been there when I entered the lectern, was taming complexity. Taming complexity or simplification, I think, is a key word for what is now topical in terms of financial market regulation, because we have come a long way in terms of harmonizing financial market regulation, in terms of giving teeth to financial market regulation. I think that was important after the global financial crisis, and so far we've been very successful in re-establishing trust in the financial institutions, and at the same time also giving clout to the European financial market through the means of harmonization. But as is always the case, you can always, even of good things, you can sometimes do too much. And more regulation is not always better regulation. So what we're supposed to look at is how can we improve, how can we make regulation better. This might be the same amount of regulation, might be less, might be more, but it should be an intelligent regulation that gives the financial institutions the necessary air to breathe, so that they can fulfill their important societal task of supporting innovation, financing transformation processes, providing, and from a German perspective, I may say, providing in particular the small and medium-sized enterprises, which are the backbone of our economy, with the necessary financial means to develop and to foster economic growth. And so we have reached a degree of complexity that I think has to prompt the question, can it also be simpler? Can it be simpler? Can it therefore impose a lesser financial or staffing burden on the institutions concerned? How can we make it more efficient? With perhaps less burden, less strain on the financial institutions, nevertheless, we can make the same contribution to guaranteeing financial stability, which is, of course, the core and major goal of financial market regulation. But perhaps it should not be the only goal. Perhaps we should include things like what's the economic impact of regulation on the financial sector? Does it really address the core issue of financial stability? That means market failures and wrong incentives for the people acting within the financial institutions. And so putting it all together, yesterday at the dinner, I had the pleasure to hand the word afterwards to Michael Hager from the European Commission, and there I referred to the new proposal by the European Commission on legislation, on how to shape European legislation in the future. And I cited the buzzword that triggered me most of this proposal by the Commission, that is simplicity by design. And I think that's the new challenge. We all know how to regulate. We can do it, quite intensely, quite effectively, but perhaps at a high cost, as we see now. And now the new challenge is achieving the same goals, achieving the same level of guarantee, in this case of financial stability, but by less intrusive means, by means which impose a lesser burden. And I think simplicity, simplification, taming complexity, that's the cue. And I'm curious on all the contributions that will come throughout this conference in order to tell us what we can do in order to approach this goal more effectively. Thank you very much for your attention. I'm happy to hand over to Thomas Gstädtner.
Ladies and gentlemen, dear Minister, thanks very much for these warm words on the EBI. I also would like to welcome you to today's event, the academic conference here in Brussels. A special welcome, obviously, also to our hosts, and thanks very much for being able to have this event here in Brussels at the Representative Office of the State of Hessen. A special welcome also to the academic president of the EBI, Christos Gortsos, and the Chancellor of the EBI, Enrico Leone. Welcome here. I'm honored to open this conference today after Professor Lorz, because we are covering the topic Taming complexity, and the EBI has published a report on this topic, working on that in the last month, called Simplifying EU Financial Regulation. It's a topic which is central to the EU agenda at the moment, and I'm very happy that the EBI is able to contribute to this public debate via its own report. I think that shows the added value of an institution like the EBI, that they're able to pull together resources from all across Europe, work interdisciplinary across jurisdictions, and contribute as a research institute to this work. Many people have participated in the work on this report: the academic board, the associate researchers group, and the young researchers group. I would like to thank all of them for their contribution. But a special thanks goes to Christos Gortsos, our academic president, who led the research and coordinated the whole report. So thanks so much, Christos, for all the work. It's a great pleasure to have you here, obviously, and also all your fellow academics who can present now the results of their work. And I'm very much looking forward to that. We have also many speakers in today's conference. I would like to welcome all of them, but let me especially welcome our two keynote speakers, Dirk Zetzsche and Filippo Annunziata, who are here in the first row. Thanks so much for being available here today and for speaking to us. And then, last not least, I would like to thank the law firm Simmons & Simmons for helping us with the organization and supporting this event today. Regulation is a central part of the discussion for more than 15 years now. After the global financial crisis. Some say a regulatory tsunami was launched, and it has been taking on for the last 15 years. And now we are basically at the situation where the angle on regulation has changed quite a bit. Whereas in the last 15 years, I would say the common understanding was that more regulation is necessary in order to make the financial system more stable. Now the question is posed whether policymakers overdid it, whether there is too much regulation, where everything has become too complicated. This debate is getting louder, especially since in some jurisdictions, for example, the US, they have launched a clear deregulatory agenda, also in the area of banking. But not only on this level, but also with many member states in the EU, reducing bureaucracy is becoming one of the key goals, and is also one of the key goals of the European Commission in this legislation. Hence, I guess it would have been naive to think that this whole discussion about deregulation, reducing bureaucracy, would go without touching also on the banking regulation. I'm happy that the EBI is starting the debate about regulation and simplifying regulation, not with a blunt proposal to reduce regulation or deregulate, but it's basically starting with the proposals to simplify regulation, also, as the minister has said, to make it more intelligent, to make it more effective. I guess it's also something we all, or policymakers, own to the public, which has been paying billions to bail out the banking system in 2008, that now we think very carefully which areas have become too far and which areas could be made more effective. I think the central question, and I think you alluded to that as well, Minister, is that regulation, the question is whether regulation is effective and efficient. And I guess that's certainly an area where further adjustments are justified. Most regulation is obviously effective. You achieve some effect with it. But the key question is whether the rules are really proportionate in relation to what you achieve in additional microprudential security as compared to, for example, increased compliance cost compared to the impact on regulation on the competitiveness of banks, and if you compare it against the impact of regulation on financing or bank financing on the economy. And this is, I guess, the point where we need to start, and where all the discussions needs to touch upon. Yeah, I think bank regulation is justified by the importance of the banking system for the whole economy. Yeah, it's justified by the fact that a bank failure would impose, as we have seen, huge costs on the whole society. And nevertheless, regulation needs to reflect the appetite of a society for risk. It needs to factor in also the impact of banking regulation on other factors as the ones I mentioned before. And this assessment is never static. It means in 2008 it was a seismic change. It was mutually agreed that more regulation is necessary, but it doesn't stay static. Yeah? After a while, it's good that the discussion starts anew. What exactly is needed, whether the regulation introduced is effective and specifically also efficient. And I think we are now at this stage where a good discussion shall take place. And I'm happy that we are able to contribute to this debate. Thanks very much again to all the academics for presenting this report today. I wish you all very interesting discussions about regulation, about simplifying regulation. And I would close here, and thank you very much for your attention. I don't know, Christos, I think we are starting now with the conference, and thanks very much.
So if I may very, very briefly, thank you very much for being here. Thank you, Mr. Minister. I fully understand, but in your presence, allow me to thank the Landesvertretung, von Hessen here. You have done a tremendous job in preparing this event, Andreas and your team. Thank you so much. It's usual to do it at the end, but I thought that I should make this acknowledgement right from the start. because your professionalism in organizing this has been astonishing. I will propose to Thomas that every time that we organize an event, you should be involved. I don't know whether this is a punishment or it's merited, but still, we very much appreciate it. So, thank you very much for your kind words, for your introduction, for your discussion yesterday, and to wish you all the best for the rest of this week and onwards. So, very, very briefly on this report. This is the byproduct of a collective work, meaning that there are so many people who have worked on it. More or less, others more. The report has all the names of those who have contributed, and in particular those who have coordinated. And this is a new element in this respect, because we are 3 members of the academic board and 3 members of our young researchers group. And this is, I think, a fair balance, because the first draft under our guidance was prepared by the leadership of the young researchers group, Fabian, Milena, and Thomas. Thomas is here? Thomas? He's coming? Okay, fine. Here he is. Hello, hello. And then we have opened it to all the members of the academic board, and here we are. Apparently, it does not reflect a common stance, yeah? And this is very well acknowledged and very carefully acknowledged at the beginning, because there are differences in approaches, yeah? Even if we take a couple of ourselves who are much closer in what we mean by regulation, deregulation, targeted deregulation, what are our expectations about simplification. Mine are the lowest, the expectations, I mean, yeah? But still, time will prove that I'm wrong. We have managed to make a synthesis. And this is a synthesis not so much on issues concerning the substance, but issues concerning, and I believe personally, that this is the value added of this work in terms of conceptual clarity, yeah, to define the terms. What we mean by what? And what should be the expectations of those who are speaking about simplification, yeah? If you read simplification and you believe that all the rules will be posted from the single rule book, then you are not reading correctly the term simplification. If you believe in deregulation, you need to define what kind of deregulation, and so on. In that respect, it is my great pleasure that we have you here today, my dear colleagues, and some guest speakers. Yeah, we have tried keeping the academic character of this conference to involve the industry. Yeah, apparently the European Commission, apparently the ESAs. Yeah, on top of that, all those who could positively contribute to our work. Our single work, yeah, the byproduct, the report has been submitted to the European Commission for the consultation, and we very much hope that at least one footnote would be made to our work. If it's 2, I would be flattered. If it's 3, it will become dangerous, yeah? But still, I think that we have managed to produce something which makes sense within the context of the discussion. I have the great pleasure to have invited my great friend David Muñoz to be the coordinator with me of the two panels, meaning that he will do most of the work and I will be there with him. But still, thank you very much, David, for having accepted this. And we hope that we will navigate you safely over the next 2 years. No, hours. Yeah, we'd need more, but we can do it in 3 or 4 hours through our work. Many thanks to all those who are participating in the panels. And first of all, to you, Dirk. You are the first keynote speaker, and you have the floor.
Thank you very much. Good morning. Also from my side, the first time when Christos approached me whether I'd like to speak here, I said no, because I'm in my research sabbatical, but the other consideration was also that I'm not the main author of this report. I commented a little bit on it, and so I thought it's inadequate if I give the keynote speech. But then he convinced me with his charming way that maybe this is exactly the idea of an academic debate, to agree to disagree, but also to be clear where the lines of disagreement are. And so I see my function today as a bit of a commentary on the report, but also dealing in particular with one element which is shown in the report, which is the aspect of to what extent deregulation is part of simplification. It was interesting. I was at a fintech conference a couple of weeks ago in Malta and found a booklet from a fintech provider, and his diligence simplifying complexity. And I thought, this is so nice, yeah, simplifying complexity, that I should try to involve it somehow in our presentation today. Ladies and gentlemen, the element of targeted deregulation is part of the EBI report in several ways. So simplification has two dimensions. First, redesigning how we write law. That's one element that probably my friend Filippo will later address more. And the reduction of rules, targeted deregulation, to the extent that we all agree targeted deregulation is not the same as structural deregulation, which we see in the US right now. But on the other hand, it comes also to a point what prompts lawmaking, in particular the element of which laws we write, why. And in this regard, I think we as academics agree we need to have evidence-based regulation rather than mere political regulation. And that leads now to the main problem. In what respects shall we regulate, and in what respects must we maintain the rules and just reshape them so that they're cheaper to implement and they're less burdensome to deal with? And this is what I try to address in my keynote for the next 25 minutes. Ladies and gentlemen, I've thought about this a little bit in scholarship and thought in theory it's all easy, correct? In theory it's super easy to regulate. You just need a simple equation where the cost of a rule exceeds the benefits. You have a case for deregulation. And where the cost of the rule are lesser than the benefits, then we should maintain it. So in theory, we have no problem, correct? But where is the problem? The problem is that the views on what the cost and the benefits are diverging for every rule. And they are diverging from the perspective of the person who looks at the rule. To give you a very simple idea, is egalitarian distribution a function of financial regulation? Probably most financial regulators would say no. But when you ask the decision makers, those who impose the rules, the people from the European Parliament, they say absolutely, fairness in the society is part of financial regulation. And here already the problem starts. What do we embed in the regulation and what we keep out of the regulation? And I have tried to frame all of these problems with the term bounded regulatory rationality. Bounded regulatory rationality, you all know the term bounded rationality from behavioral finance, but there is, of course, also bounded regulatory rationality, that the regulator is simply not rational. He's following a lot of biases, incentives, and so on that are kind of harming the effectiveness of regulation. I first want to make the case for targeted deregulation. Then I will look into the issues of bounded regulatory rationality before I make some 5 very simple proposals, which I believe could nevertheless reorient the lawmaking in the European Union. We all know that we justify a regulation because we want to address 3 types of problems. On the one hand, we look at the firm internal agency conflicts. In particular, when you look at a bank, we have the depositors, we have the shareholders, we have management as traditional constituencies. And we know that up from a certain point onwards, the bank, as a highly leveraged institution, has a certain incentive to speculate on 2 constituencies which don't have a say in the decisions, the depositors and the public. Public because of the bailouts. The second element why we regulate is reducing negative externalities, in particular market failures. Here, the traditional element is highly leveraged financial products, where we usually offload our insolvency risk on the other side, the counterparty. In this regard, the reduction of market failures has led in the last 15, 20 years to an abundance of rules on leverage. In particular, you find it in all pieces of financial regulation. I'm not entirely sure whether the lawmakers really knew what they were imposing when, for instance, they asked certain investment funds to disclose over-leverage, because that will lead to a lot of market frictions if you disclose it. So far, Article 24 of the IFMD has never been triggered, in my view, but these rules are nevertheless in there, and that gives you a certain idea of the view of these things. Then, of course, the last element, and this is often underemphasized because people don't understand it, there is a transaction cost reducing function of law. Let me give you one element which functions super well. You know, I'm from Luxembourg, and the most successful investment product of Europe is the UCITS. The UCITS is a retail product which we sell in 120 countries, and it works because everyone knows the UCITS brand. And we have a number of these type of transaction cost reducing ideas by building certain type of terms. So for instance, we freaks, so to say, when we speak about PSPs, we know what we speak about, correct? And this is a transaction cost reducing effect in building boxes of financial regulation. And of course, these boxes must be cut adequately. And here's a problem coming. When you come from MiCA, MiCA has de facto substantively a payments function, but it's not a PSP. So where is the line between MiCA and PSP is a huge problem in law, because you need to be in one or the other box. And maybe this type of problem also gives us a certain indicator what the challenges are, in particular, against the many arguments in favor of deregulation. Well, these come primarily from the US, but I want to highlight just a few things which are obvious. Of course, regulation costs money. Yeah? The implementation always asks for a lawyer, either in-house or out, incoming lawyer. Regulatory arbitrage is a problem because the laws are never perfect. Then, of course, the more laws you write, the less the management is accountable for what it's doing. When you can blame the regulator, you don't need to take the blame yourself. Besides these more political arguments, I think there is a very important structural argument in favor of a certain type of deregulation, because when you go through all the rationales of financial regulation today, the right type of deregulation supports it. Of course, let me just take the most obvious one. Financial stability can be threatened because of counterparty risk. But the larger threat to financial stability are unprofitable financial institutions. If a regulation is so costly that you can't make profits anymore, this is probably more a challenge than counterparty risk, because in such an environment, there will be no counterparty risk, because no one accepts you as counterparty, correct? So in this instance, we see that too costly regulation, of course, is a problem also for the established rationales of financial regulation. And this is something that regulators, and I work quite a lot with them, need to understand, that there is not only too much regulation, but also that regulation undermines the effectiveness of existing regulation. So it's not just about deregulating and that's bad, it's quite the opposite. It is achieving a level of regulation where the benefits exceed the cost. And this is something, of course, more is not always better, but only the right law furthers the purpose of financial regulation. I can go through all the rest, but you're professionals here, so I will spare you the time because I have some other points that I want to make. Ladies and gentlemen, why is our simple cost-benefit test not working? Well, our simple cost-benefit test, of course, has limits. And these limits I want to put into 3 pockets. The first one I already said, that the regulators itself are limited. Usually, the limit that we're all facing as humans is that we cannot price in the uncertainty of the future. Of course, now you have 2 approaches to the future. You can fear it and ban it, try to avoid it, or you could be open, accept the risk, and deal with it when they materialize. There is a clear study that most risks we fear don't materialize because we take precautionary measures. Those risks materialize which we don't see. And that should tell us something about preventive regulation. Because when we don't see the true risks that are coming, all preventive style, future-looking regulation is nonsense. Yeah? In this regard, when we look, for instance, at the wonderful last proposal of the European Systemic Risk Board to prohibit multi-issuer stablecoins, this is absurd because not a single one of these multi-issuers is in Europe. So what we can protect, we cannot prohibit the effects. What we can do is prohibit our financial institutions to deal with effects. It effectively, this ban threatens the position of the early competitors to the international ones. And there are 7 conglomerates right now in Europe trying to compete with the dollar-oriented multi-issuer stablecoins. Yeah? So what did our regulator do? It proposed prohibition of an innovation which we didn't have in Europe. That is wonderful, correct? Because it means we will never develop these innovations under the threat of regulatory uncertainty, what will happen with the things in the future. Yeah? So this is a showstopper for any type of innovative investment. And I could go on. I have a long list of 20, 30 of these examples where we fear something that we don't know. And we ban it before it even materialized. This is interesting as a regulatory approach, but it can be explained from the regulatory rationality that they don't want to be the one to be blamed later. This is a lesson after the last financial crisis. We hear this always, the financial crisis is a scapegoat for everything. Every bad regulation is today justified with the financial crisis. The very fact that regulators were incapable of seeing that the respective models of the banks had limitations, although they knew all these models, has always been disregarded. Yeah? And this is just something very much in the run-up of the crisis, which is usually tamed in a way which I find very interesting. Well, the other thing which is obvious, when you don't have jurisdiction over something, you can't regulate it. Take again the example of stablecoins. We have limited expertise. A wonderful example, again, from my work with regulators, also from the ESRB. The person who were running the working group of multi-issuer stablecoins didn't know what a stablecoin was. Super. Exactly the right person to ask. Yeah? That's like the car engineer who deals with financial regulation. I love car engineers, but I like them in my car and not in financial law. Yeah? So we have an expertise problem and a resource problem because resources and expertise go hand in hand. Usually we regulate before we have experience. When we regulate something that we don't now, we fear the unknown rather than going forward. And that should tell us who shall regulate. It shall be the people that actually have the cases and not the people that have anticipation of what comes in the future. And then, of course, the institutional agency conflicts, this blaming, I'm sorry to say so, that we heard yesterday night between one institution blaming the other one and no one taking responsibility. I think the European Commission has the choice who writes delegated acts in their original proposals. They can simply not delegate, and then there's no delegated act. It's quite simple. Or if they don't like it, they can reject it and send it back. Or they could just rewrite level 1. So there are thousands of ways to avoid overregulation, and when no one takes responsibility, no one is to blame. I understand this, but that's bad for the market, because the market is the one who pays the cost for this type of passivity. So everyone is to blame, not a single one can be left out. Politics, well, this is one of my wonderful topics because we have such a wonderful example. In 2019, 2020, there were voices in the literature, including myself, telling them Sustainable Finance Action Plan, very bad idea. Because it's a regulatory experiment, there's not a single case where this type of regulation worked, and we have no models, no blueprint for this type of style. 7 years later, I think everyone would agree. But in 2020, when I was making this point, I was blamed as being unmodern, archaic, but I had a white male. I have a lot of wonderful things. I can't deny that I'm white and I'm male, but maybe I was right nevertheless. Yeah? So in this regard, it's just stupid to play experiments with your whole economy. If you want to experiment on the regulatory level, you must do it in a small, controlled environment, which we call regulatory sandbox. Yes, you can do it, but then you need to assess it, and when you want too much, you achieve nothing, or quite the opposite, you achieve only damages. So that's, of course, the dark side, because nepotism, overload, political misallocation is the bad side of politics. But there's also a white side, and the white side of politics is, of course, enhancing accountability. Yeah? So someone needs to control the supervisors, and of course, the only legitimate institution is the respective elected representative. Well, now I'm in Brussels, so I don't want to raise that major question whether the European Commission is effectively controlled by Parliament, but that, of course, is a major question which we will put aside for today. Well, and of course, in our little equation of cost-benefit, there's a problem of non-monetized goods. Data protection, a typical problem. Yeah? What is the value of freedom? What's the value of, let's say, less supervision by certain financial services? My cell phone knows more about me than myself. And of course, the more I aggregate this data and so on, there is a certain limit that must be set. And of course, here, that is, I think, the original Parliament's privilege, where it must be out of this equation. But beyond these limits, and I would cut them smaller rather than larger, this cost-benefit must be applied. Now I turn to something which I like, because what inspired me to think about targeted regulation was a statement from Jacques de la Rosière. No one can blame Jacques de la Rosière not to be a true European, correct? And Jacques de la Rosière was a long-time responsible person for Europe. And he made this statement at the ESMA conference last February. And I loved it. I loved it from the beginning. To regulate financial markets, you must be a capitalist. Financial regulators must take the perspective of a well-meaning mother or father who is painfully aware of the deficiencies of her daughters and sons, but nevertheless wants the best in all they do. And I can tell you that most regulators of the last 10 years hated the financial markets. They made electorate stories about hating financial markets. They created majorities by blaming the banks. And that goes back to a finance minister in France in the 19th century who said, whoever wants to send the bankers to the guillotine will regret it and want to reanimate them 10 years later. Okay, that is now the problem. We killed the financial sector willfully because we hated them. And now we understand we can't revive our economy without them. And of course, I think this is super important to adopt the bon père attitude. Of course, our children and sons, our daughters and sons, I have 2 daughters, are deficient, but I love them nevertheless, correct? So let's love the deficiency and try to make the best out of it. And I'm thinking in this regard, we need to now be also a bit true to ourselves. There's a lot of boilerplate nonsense in our regulation, and I just took here a lot of stuff. Harmonization is my most hated word. Why is harmonization nonsense? Because harmonization doesn't tell us in which direction harmonization takes place. For instance, we can harmonize by cutting all rules, or we can harmonize by imposing all prohibitions, the quite opposite way. Harmonization doesn't tell us anything. It doesn't tell us the benchmark against which we make laws. It's just a buzzword. And you find it in every piece of regulation, and for that reason I'm also strictly against Article 140 of the Treaty of the Functioning of the European Union, the harmonization rationale, because it is just nonsense. Yeah? No one replaces a sound analysis with the word harmonization. But when you read all the rationales why we regulate, it's because of harmonization. Cross-sectoral consistency, another word like that which doesn't make sense. Why? Cross-sectoral consistency doesn't tell us what is equal. I can only regulate equal things with equal rules. If I have unequal things, different rules for different things, correct? So we have a lot of these buzzwords, proportionate, just, fair, balance. Yeah, as a lawyer, you think, well, this is all political. It is nonsense. It is not justified. It's not in this cost-benefit analysis because no one takes a decision. And this is exactly one of the problems in the daily application. I have to say, conflict of interest, I'm also an independent board member of financial institutions, and I get all of these rules and don't know what to do. And that is now wonderful because my lawyer opens a champagne bottle with every piece of legislation coming off of Brussels because he knows he has business for the next 5 years. Yeah? Because we will ask them for legal opinions to free us from liability. We are freed by liability by paying to the law firms. Yeah? And this is, of course, costly type of regulation. This has nothing to do with what is written in the law. It's just how the law is written. So we need to avoid these type of unclear terms, yeah? Because they are a feast for lawyers and terrible for the profitability. And of course, I'm sorry to say it here, sometimes broad open standards are better than apparent rules that are then broadened with these type of things in between. Yeah? So we need to have a certain self-responsibility back on the side of the respective financial institutions. For instance, I believe we can cut all MiFID. We can cut the whole MiFID with Article 18.1. It's all in there. You have to act in the best interest of your investors. Number one, stop. Of course, we all know it's too simple, but I just want to tell you that this overarching principle can function very much to hold people accountable ex post. And that's about the distribution between ex post and ex ante. When we don't anticipate all the risks, maybe it is not a good idea to regulate with expectation that we have all risks considered. The only one that we protect is a financial institution who can say in 90 of these cases, well, there's this little bit of exemption which you gave me and now I can abuse it to rip off my clients. If I have this overarching principle, the court will hold me accountable in a couple of years and I have to put in this as a disciplining measure in my decisions today. The more and tighter rules are in the interest of the large financial institutions who can kind of navigate in between these boxes. They're not raising disciplines. I'm also believing that much of these rules, and I observed that in the run-up of the IFMD, have been written by large consultancy houses influenced by someone else. I can show you that based on the type of rules, because many of them look like the compliance guidelines of whatever the large houses of the world. All right, so we need to accept competition. Competition not only among institutions, but also competition of regulators, because they drive regulatory innovation. Let me give you one idea. I come from a country where the regulator speaks 18 languages. 18. Why does a regulator of Luxembourg speak 18 languages? Because they distribute financial products to 120 countries. So speaking 18 languages comes from the necessity to be a regulator in an international financial center. That's a good thing, correct? We all agree that's very client-oriented because it enhances the efficiency of compliance measures and so on in international supply chains. I think that these type of regulatory innovations, I can give you the next one, regulatory sandbox, invented from the Financial Conduct Authority in 2015 to be active in a market characterized by the regulatory thicket. Or the Innovation Hub, innovation in 2014. It comes from the Luxembourg Department of Financial Innovation. All of these regulatory innovations are responding to a certain need. And when you take away the benefit, like the positive reputation, the fact that these bureaucrats can travel around the world and show themselves off as being a modern regulator and so on, all of these incentives in the regulatory system. If we take away this incentive, we get the type of bureaucracy which we don't like. The old style bureaucracy working from 9 to 5, but only if it's not Sunday, Monday, and Tuesday, Wednesday, Thursday, Friday. Yeah? So this is exactly the point. We need to bring these type of incentives also into the regulatory system to be the best regulator and not just any regulator. So regulatory innovation and competition of regulators drives it. I want to be more precise because competition of regulators only often sounds like deregulation. Let me say competition of supervisors, because then I see now Christos Gortsos also nodding because he's very strict on the term regulator or supervisor. Competition of supervisors for the rest of the day. So, and clustering by cooperation is the opposite of clustering by centralization. So if 5 countries together have the critical mass for a certain business, they should cluster by cooperation and build the necessary teams. If, for instance, smaller European countries don't have crypto, then it doesn't make sense for them to have jurisdiction over crypto, correct? So they should cooperate in the sense that to build critical mass and build 5, 6 clusters that compete with each other for the best style of supervising and adherence to the common law. And of course, then the European supervisory authorities have a clear role in making sure that this competition is fair, that they all apply the same rules and that they make sense from the perspective of the single rulebook. My 4th point is we need sandbox thinking of innovation rather than superimposing the grand design. Let's first test it, review it, optimize it, and then gradually feed it in. This is, of course, something that comes from fintech and originally from biotech, by the way, and it is super important that if you go on sandbox thinking, that it is paired with transparency. Whatever you do must be transparent to everyone, because otherwise you undercut European rules by calling it sandbox. That can't be. And the last aspect, of course, is evidence-based regulation. The main problem of regulation is uncertainty. Did I cover it all? And the answer is you will never have. But do I have sufficient evidence that the costs exceed the benefits? Well, if I have the slightest doubt that the costs exceed the benefits, I should not regulate. So in doubt, deregulate rather than in doubt, regulate and wait until no one is alive anymore that can be regulated. So let me give you my personal key messages. Less is more where more is not better. A wonderful example is Article 78 CRD. Sorry, David, I need to be opposite you today, but Article 87A CRD is probably one of the worst rules I've seen in life. Because it's so unclear and it imposes the political goal of 2050 into the ESG risk management of banks. I don't think it's a task of the banks to tell the clients that the clients must think green. If the client is liberal and he wants to be brown, let's do it, but we have other means than banking regulation to keep them from investing in brown things. For instance, we can tax whatever use of petrol. We know there's also the perspective. So there's this important point when you deal with these type of rules to distinguish between the impact on sustainability factors and sustainability risks. Sustainability risk is the right aspect of Article 78. The impact of sustainability factors, this political dimension, is a wrong one, because it is fearing the unknown and it is harming the financing power of the European economy. So I would limit it back to clear sustainability risks, data-driven and not political-driven. Next aspect, openness to innovation with entry at the gates. I preached this for 10 years. Of course, when there's little innovation, there's not a strong need for centuries, correct? And right now, let's be fair, Europe is a desert when it comes to fintech. Yeah? We are more or less, we're way behind India, we're way behind Singapore, we're way behind the US. Well, we may be even behind Kenya. So what do we regulate? An industry that doesn't exist. Okay, so let's be frank about our position. Our position is we are the developing country here. In terms of fintech, we are the developing country. And when we say something else, it's just political nonsense. It's not the task of regulators to evaluate innovation. I was part of a mediation procedure inside the ESAs where people discussed whether crypto assets is desirable. They wouldn't have any value. Is it the task of regulators to tell others what has value? Remember the story, and I like it because it's so wonderful. In the 19th century, when the Prussian king observed the first car, he saw the car crash because it didn't have a safety belt and it didn't have a wheel and it didn't have brakes. And he said, well, very interesting, fascinating, but it will never replace the horse. This is about foresight when it comes to regulation. So it's not the task of regulator to say an innovation is good. It's task of the regulator to have an enabling environment with sentries at the gates. And sentries doesn't mean that the gate can still be open, correct? So, a next point here, in times of uncertainty, broad principle with ex post adjudication, then that can include the SREP reviews, by the way, are better than detailed imperfect rules ex ante. Ex post in our supervisory circle is still annually. You can rectify things. You don't have to do it ex ante. Let me give you an example. The risk weights for non-significant banks. I believe they're utterly wrong. They're written in Basel now for 30 years, and they come back from a time from the 1970s, the Herrschaftscrisis. Don't you think that there is a need to reassess what has been written in the law 50 years ago, when the income distribution was different, the growth assumption was different, and when probably the share that people had in some countries to consume was entirely different? What I say here is that maybe a certain strictness in the rule is part of its inefficiency, because these detailed imperfect rules create burden. The European legislator has partly recognized that by its kind of kicker for SMEs. Yeah? So there's a certain privilege in for SMEs, which we decided as Europeans, but I'm thinking we need to rethink whether this kind of rigid overall system is good, or whether we shouldn't work with a corridor and then go more for an internal rating-based approach, more or less for all banks. Of course, we say EIB is too expensive, but if EIB is positive for the bank, wouldn't it then be necessary to apply it not only to the most 150 significant banks, but also to the remaining 5,000 that serve 80% of the people? Harmonization is no panacea. Sorry, I'm German. So Article 114, Treaty of the Function of the European Union, may function as a regulatory weapon of mass destruction. And I like this sentence because I believe it's true. Harmonization is not the solution. If the rule itself is inefficient, harmonizing across an inefficient rule is the worst we can do. I'm sorry. Yeah? So first the rule must be good. And then we can agree how it is the best. And probably there's a good cause for dealing only with the biggest stuff on the European level and leaving a lot of discretion to the member states. Proportionality requires moderation. I don't regulate is a very, very ambitious decision on the side of the regulator, but it's the best if you have no clue what you do. Some risks must remain as risks and returns correlate. If you try to regulate everything away, and that's very clear in our report, Christos made sure that it's very clear, we cannot avoid that risks materialize. That's part of capital markets. If the risks would materialize, we have no reason for capital markets. For financial markets, it's all about risk allocation, correct? So, of course, risks must remain. It's not even impossible to regulate or risk array, but also it is super important that we undermine the very functioning of markets the more we interfere with these type of risk allocation mechanism. And that's something where I believe regulators very often try to take away the fear of the electorate, but sometimes it's better to let things go. Finally, why is simplification so difficult? Simplification touches upon the unsolved issues of the EU. Just to name three: legitimacy, centralization, degree of economic freedom. And because of this underlying political frictions, also the simplification debate, I'm sorry to say so, is very often super high level, but when it goes to the details, everyone agrees to disagree. With that, I'm at the end. Ladies and gentlemen, target deregulation furthers the effectiveness of financial regulation. A strict cost-benefit analysis is important. Better enforcement of better rules is desirable for all. Better enforcement of poor rules, unfortunately not. And we have a lot of deregulation potential, but I want to end with Jacques de la Rosière. The bon père attitude will probably be very helpful if it was truly adhered to by European politics. Thank you very much for your attention.
Yes, can you hear me, everyone? Yeah. Okay, so I wish to thank Dirk for a fantastic presentation. As always, I think that he brings to the table something that I sorely miss in European context, which is a fresh and provocative attitude. So he's not afraid of saying certain things, whether you agree or disagree. And I'm sure that we will find plenty to agree and disagree with this, but that's why we have this debate. So thank you very much, Dirk, for this. Before I invite the rest of the members of the panel to come forward, a couple of reflections, also thinking out loud after hearing Dirk's presentation. I do agree that regulators have to regulate as capitalists. I would challenge the parent analogy, though. Being a father, I have a massive conflict of interest towards my children, and I think regulators shouldn't be conflicted when regulating markets, not as parents are with children. So I would be careful with analogies, even if they come from Jacques de la Rosière. A second reflection is, I completely agree with the need for stricter cost-benefit analysis, but one of the simplifications that I often find in cost-benefit analysis is that people tend to move from cost-benefit analysis to expected utility theory. And expected utility theory works provided you have a probability distribution for the presence of a shock. When you don't have a probability distribution, but you have uncertainty, you are in a different scenario. As Gilboa and Schmeidler showed in 1989 and subsequent articles, proper decision-making matrices need to incorporate the presence of uncertainty, and they, for example, propose decision-making based on max-min with multiple priors, for instance, and this max-min would be present in a more precautionary approach that thinks about scenario analysis. That's one thing. And then we can challenge whether there's an analogy between the scenario envisaged by the regulators and the scenarios that may really materialize. That's where the discussion should be. And there's a second element, and I think that's probably the problem we are also addressing today, which is that you cannot avoid every single scenario, because part of the regulation that you create to avoid one scenario may precipitate a different scenario. And in that sense, I think that's where the problem is, because regulators, legislators often incur a fallacy of composition. They envisage so many scenarios in separate legislative tracks that eventually the overall framework, once you look into it, does not sit well together because it is trying to tackle too many scenarios at once. So in that sense, I think that is closer to the mentality of simplification that we are trying to tackle today, one that takes the view of the overall system and how the different rules and principles, I think that is very important to emphasize, fit together. So in that sense, hoping that...
if I may,
yes.
Thank you, Dirk, for this. Coming back to the beginning of your presentation, where you correctly combined the case for banking financial regulation with market failures. Yeah, this is absolutely correct and theoretically robust, and I think that it should be a guiding line for any kind of regulation. Forget about the information asymmetries, because in my view, this is mainly consumer protection law, or in capital markets also investor protection. But in banking, the key concern is the other market failure, which is negative externality, yeah? And which is mainly due, but not only, to banking panics, which are induced by information asymmetry. So here you have a combination of two market failures. My key concern remains always the following, because otherwise I would be tempted to subscribe to most of what you said. Negative externality means that there is a possibility that the failure of Gortsos Bank will lead to the failure of other banks, correct? And in that respect, it is expected that you make all these extremely heavy regulatory framework in order to avoid this probability, yeah? Probability that the failure of one will lead to the failure of the others. Taking your example that overregulation may create victims in itself, you are correct. To the extent that you have more overregulation, you have more regulations after a company has been set up. Because if you know the rules, then you need to incorporate the compliance cost in your business model. Otherwise, you should not undertake. But if you work with a given regulatory framework, in the next 10 years, you are given an add-on of 50%, then you are correct. So my key concern here, as I was hearing you speaking, is to what extent can we rationalize the extent of regulatory intervention, making regulation less. Yeah, I would not speak about deregulation. It may be the case that you make a softer framework while preserving the public good, which is called financial stability. Because this is, at the end of the day, the key concern. Yeah, you don't want to have too many victims in the row. I don't know what is the optimal blend in that respect, given also the fact that the public good as such is not incorporated in business models usually, yeah? Meaning that when I do business and I take risks, I don't work under the assumption that I will fail, yeah? So this is not very well internalized in the business development, meaning that there may be a higher exposure to risks than warranted. Just thinking loudly and having no conclusion on this very delicate point. But Jens is waiting here.
Yeah. So now we are going to move to the part of the discussion of the panel. So we have with us. I wish to invite those of you who are with us today to come to the panel. So today, for the next stage of the discussion, we have with us Bart Joosen, who has been affiliated with many institutions, University of Amsterdam, University of Leiden, Florence School of Banking, and he's a major expert, probably, I don't know anyone more expert in the field of prudential regulation, bank capital requirements. We have also with us Jens Binder, who is a professor at the University of Tübingen and also a fellow colleague and friend, member of the EBI academic board. He's a major expert in bank regulation, the banking union, as well as corporate governance, and can offer, I'm sure, a perspective that straddles across both fields. And finally, we have with us Marnix Wallinga, who is an associate professor at the University of Leiden, and is a major expert in the field of liability for the breach of investor protection rules, so he can offer a more capital markets perspective, also coming from private law. I think that this is an excellent panel, and without further ado, I'm pretty sure that you have plenty of comments. In the interest of expediency, I would give the floor to Jens first, and then perhaps move to Bart, and then to Marnix. So
10 minutes.
10 minutes each, yeah. We have to be strict with this. Jens, thank you very much. The floor is yours.
Well, thank you very much, David. I hope you can all hear me.
We cannot. Wait a sec.
And it seems to be a noise issue, which now should be working. Can you hear me?
Yes.
Excellent. So let me start, first of all, with a huge amount of congratulations. Congratulations to all the organizers of this event, and above all, congratulations to all dear colleagues and friends who have contributed to the excellent report. I think this is a fantastic basis for the further development of the simplification debate, which, as far as I can see, having not been involved in the report directly, is one of the key topics of that currently is at everybody's in everybody's attention. So thank you very much for that. Thanks for having me, and my sincere apologies for not being able to make it in person. Right now, it is my annual teaching slot in Milan, where I teach at the university, the Catholic University, and unfortunately, I could not possibly shift that commitment. So I'm grateful for having been given the opportunity to communicate with you remotely. Now, having listened to the earlier presentations this morning, and in particular to what Christos, Gortsos, and Dirk Zetzsche presented, I guess it might be good if I try to sort of convey my own views on some of the topics raised in the report. Of course, not all of them, because that would be impossible, let alone in 10 minutes. And I think if we want to discuss how to move further from this basis, it is important to note that given the dimension of compliance costs involved in complying with the ever-growing body of laws and regulations and sub-delegated and delegated regulations, and then less binding instruments such as recommendations and guidelines, it is important to note that simplification, the topic of today's conference, and indeed proportionality, will probably mean very different things to different types of actors. And this will depend a lot on the size and international presence of these actors. I know that we will have industry representatives, including from my country, later in the course of today. And I think they will raise that same topic. I think that while simplification-related topics are important across the whole industry, irrespective of the size and complexity of relevant institutions, they matter a lot for idiosyncratic reasons for smaller institutions. And of course, that directly points to a particular problem for the future development of relevant policies in the EU. And that problem is that European banking systems across the EU continue to be very different. There are some jurisdictions with a very small number of banks. There are others with large numbers of small banks, and Germany is a good example for that. We have a very complex banking system involving 3 different types of banking institutions. In particular, lots of cooperative banks operating in the country, lots of public sector savings banks operating, and a great part of this difficult landscape, which has evolved historically and can be criticized, of course, on the ground of efficiency, but still exists. A great deal of these banks are struggling enormously to actually cope with the level of complexity that has evolved, particularly after the global financial crisis. So for them, I think, and this is worth noting, this is not a problem that merely impacts their competitiveness vis-a-vis foreign competitors. It is sometimes a problem that threatens their very existence, and it should be treated as such. And this is why we can expect perhaps more support for specific projects aiming at substantive changes to the existing rule books than we can see from other jurisdictions. Now, how does that relate to the general approach taken in the report? Christos, Gortsos mentioned that there is a difference here which needs to be debated, the differences between modal responses to simplification, that is changes to the way we actually legislate and regulate on the one hand, and then on the other hand, substantive changes, substantive simplification, something that Dirk Zetzsche referred to as deregulation. Sometimes it will amount to that indeed. Now, I think it is important to note here that if you look into regulatory theory, and there's a lot of regulatory theory on the choice of regulatory instruments more generally, not just in the financial sector. There has been a huge amount of literature on the difference between rules-based and principles-based regulation back in the early 2000s when I first approached these topics. when you look back at that debate, I think that it is important to see, and this is something I wish to draw your attention to, that it may well be the case that reaching substantive simplification within the context of a regulatory system based, as ours is, on the principle that there are rather broad general principles which are then developed further by way of delegated regulation, and then ultimately are broken down into specific standards by supervisory authorities. And within such a system, it is difficult to maintain the advantages that are commonly associated with principles-based regulation. In principle, principles-based regulation is flexible, should be flexible enough to cater for different needs by different institutions. It should be possible to adapt principles-based regulation. Because it is principles-based, because it is not broken down to specific rules, individually to individual actors in the field, taking into account their specific needs and the specific risk profiles, including risk profiles not just relating to their own risk, but including also their risks to the financial sector and financial stability as a whole. But if we operate within a system which is basically designated to produce ever more granular specification as to how the general principles are to be operationalized on the ground by supervisory authorities, I think there is a reason to believe that within this kind of structure, it is extremely difficult and will be perhaps in some areas almost impossible to accomplish real simplification. So there is a need here to reflect on the very foundations of the current regulatory and legislative system. And this leads me to my second complex of remarks, which is almost the final one already, as I'm running out of time. I think that if it may make sense to amend the way we actually legislate and we regulate, it might actually be advisable to think about carve-outs for at least some parts of the regulated intermediaries from that sort of approach. And there are examples for that, and these have been debated at length in recent years. They include, for instance, the small banking regime established in Switzerland, of course outside the EU, but in principle conceivable as a model also for the EU. The same applies to the post-Brexit small domestic bank regime within the UK. And why do I mention these? Well, because they have informed to some extent the policy initiatives from within the EU, namely from Germany, where the German supervisory agency, BaFin and Deutsche Bundesbank jointly came up with rather far-reaching proposals in relation to carve-outs from the general regulatory regime as regards capital requirements and liquidity requirements, corporate governance regulation, the supervisory review and evaluation process, and finally reporting obligations. And I think that although there are problems with any of these regimes, there are problems relating both to the scope and to the technical content, this trend, and this is something I want to highlight here, could be interpreted as a possible avenue for further developing the most valuable recommendations on simplification presented in EBI's report. This will surely have to be a sectoral rather than a cross-sectoral exercise, because these are technical amendments to existing rules that are sectoral in nature. So all these regimes, of course, relate to the banking sector. And in the remaining time, let me just perhaps highlight some of the potential problems there. Okay, we may agree or may not agree, but I'm certainly promoting the opinion that in the current framework for legislating and regulating financial activities within the EU, it would be difficult to accomplish real, that is substantive simplification in a way that ultimately will reduce the burden caused by compliance costs on particularly smaller and medium-sized institutions. Institutions, by the way, which do not conform to the paradigm that has informed the regulation worldwide, but also in the EU after the global financial crisis. So when we analyze post-financial crisis regulation, I think it is fair to say that this is regulation tailored to the need to contain the risks of large, internationally active, systemically relevant institutions. And the key problem is that, in my view at least, that a lot of individual regulated institutions within the EU, at least within parts of the EU, some member states do not conform to that paradigm in the first place, and therefore perhaps should be exempted. But then, very importantly, I think it is relevant to keep in mind what Christos, Gortsos, and Zetzsche, and also Thomas Gstädtner this morning highlighted perfectly correctly, namely that a carve-out, an exemption, is not enough, right? Also, these institutions can pose problems, and these are problems that are summarized under the too many to fail paradigm. So we actually need not to carve out them entirely, but we need to come up with perhaps a two-tier or even three-tier system that actually caters for the specific risk posed by these institutions to systemic stability at large. There are many problems here, problems of calibration, and in that regard, and this is what I want to conclude with, a comparison between the existing approaches in Switzerland, in the UK, and on the other hand, policy proposals like the one submitted by BaFin and Bundesbank could perhaps show the way in the future. But let's not expect that this will be an easy task. In fact, the devil is likely to be in the detail here. There will be very intricate policy choices to be made, which will not be made easier by the fact that even when it comes to small and medium-sized institutions, the situation on the ground looks very differently in different member states. I'm here in Italy, where the cooperative banking sector has expressed strong concerns in this regard, and when we tried to bring them together at my university in Tübingen last year, German cooperatives and German and Italian cooperatives, it was interesting to see that while all the different industry representatives are starting from the same point, it's too much and it's too complex, the ultimate conclusions they draw will look differently depending on their individual circumstances and reflecting their individual needs. Thank you very much. I look forward to the discussion.
Thank you very much, Jens. So thank you very much. Now we move on to Bart's remarks. I'm pretty sure that you may have plenty of to say. I mean, banking regulation, especially prudential regulation, being one of the major targets of the current ire towards over-regulation. Bart, the floor is yours.
Thank you very much for inviting me to participate in this panel, and congratulations, share and join basically Jens' words basically for the organization of this conference, but most importantly, congratulations with this very important report that has been written by so many of the EBI, and hopefully indeed will deserves more than one footnote. I would say at least 10 footnotes. That's what we should go for. Yeah, we are in having academic debate, so as an academic you can say what you want. My comments will be a little bit more political. That's one of the discussions that we had, and which were basically coordinated by you. If the report of the EBI would be too political, then it would take a risk of being set aside. So I take at this point in time the 10 minutes to use to make some comments that might not necessarily be very technical, legally or regulatory, but more political. One of the questions that might arise is to what extent the lack of simple, comprehensible, and therefore effective rules is also linked to the ongoing evolution of the European Union, which at times resembles the Echternach possession, one step forward and two steps back. And over the past few decades, policymakers and politicians in the EU have constantly shifting views on the application of treaty principles as the basis for legislative projects. For example, the wavering stance regarding subsidiarity and the exclusive exercise of powers by the EU institutions. And this is, of course, influenced by the political winds that blow from time to time. Let me give me two examples to illustrate this point a little bit further. Firstly, the establishment of the single supervisory mechanism. Whilst policymakers in 2012 had no great difficulty in entrusting the transition to centralized banking supervision regarding micro-prudential rules to the European Central Bank, the situation was a little bit more complicated for the powers arising from macro-prudential rules. And based on the negotiations at the time, this resulted in the difficult division of powers between the ECB on the one hand and the competent authorities in the member states on the other. And the regulatory framework in this area can by no means be described as simple, and has led to well-known patchwork of approaches regarding the application of macro-prudential rules, resulting in an enormously complex framework when assessed at the level of the European Union. The level playing field is not in place in that respect. And the question is whether the choices made on the basis of the principle of subsidiarity, because the member states basically said, yeah, we should be the competent authority to decide upon the application of a counter-cyclical buffer. That's not something which you can entrust to the ECB, for instance, or the ESRB. Ended up basically in mismatches and difficulties for the centralized supervisor, ECB, to set proper capital standards. Because if the ECB says, well, we believe that this should be the proper capital requirement for this institution, and then the local authority says, well, we will, on top of that, apply a counter-cyclical buffer or whatever buffers that are being applied, then it's very difficult to set a simple capital standard for that particular bank. We are here in Belgium, basically, and this ended even up in the national authorities imposing on some banks for reasons of protecting the Belgian markets, basically imposing a systemic risk buffer of about 11% on top. On top of, let's say, the existing minimum capital requirements. So this is my first example. And I would say this is all more true for the current resolution framework, where the complex regulations are divided between the BRRD and the SRMR, but above all, the fundamental choice to use the directive instrument rather than the regulation instrument has led to similar fragmentation in the crisis management framework for banks. Let me say it again, would it not have been more gained if the fundamental decision had been taken in that time, at that point in time, to enshrine that crisis framework in the European regulation with direct binding force and effect in all member states? I myself would be in favor of achieving the same kind of movement in this area, as was the case with the creation of the AML regulation, which was also motivated by the desire to put an end to the highly divergent levels of regulation of this matter across the various member states, and which ultimately resulted into great diversity in the application of this important matter. And moving towards a European regulation for banking crisis framework involving a merger of the BRRD and the Single Resolution Mechanism regulation, and the transfer of national rules in this area to a uniform, fully harmonized regulatory framework at EU level would represent a simplification in an area which, in my view, is weighed down by the excessive complexity as a result of political choices to apply the principle of subsidiarity in this area in a conservative manner, giving priority to the pressure from the member states to leave everything as it is with respect to substantive rules. And this time, this was also justified by applying the wrong analogy, namely that it was argued in the debate that the adoption of rules related to national insolvency frameworks should remain the preserve of the member states. And one can, of course, fully understand that at the time the member states did not wish to take that leap of faith to not yield basically to the pressure from the member states to use the instrument of directive for the regulation of the crisis management framework, ending up in a crazy divergent system of crisis management in all the member states. Each member state has its own system. Each member state has its own choices, and so forth and so forth, and makes it not simple to apply banking on a cross-border basis. It's very simple, and one may ask whether the time has now come to put an end to the almost inhuman complexity. Apologies for the legislator Emiliano, but of the various national frameworks regarding crisis management for banks, and in any case to work towards increasing the effectiveness of the second pillar of the banking union. So that's what I wanted to say.
Thank you very much, Bart. So we heard comments on political choices on the prudential regulation. So I guess that, Marnix, you will have something to tell us about investors' protection as well as liability and private law. Yeah. So. Okay. Can we project his presentation on the screen? Good.
So I missed. Is my mic? Yeah. I missed my train yesterday, so I went all over and all. Above and beyond with my presentation. It's too much for 10 minutes, don't worry. There are 19 slides, won't be able to cover them all. But I wanted to touch on a couple of issues that also Dirk touched on, and what Bart said, the lack of simple and also the lack of simple and comprehensible rules. What Dirk also said, conceptual clarity and the lack of that, especially in the private enforcement of EU capital regulation. Evidence-based deregulation or evidence-based targeted regulation, and also I think the limits of regulatory rationality. All of these are very much present in when we look at private enforcement of EU capital markets regulation. There we go. So what do we have? These you all know. What are the rules? What is the situation? There's a lot of capital flowing out of the European Union. One of the reasons we're now trying to look at simplification, deregulation. I think what we've been missing for the last couple of years, and maybe even for the last 60 years, is a focus on private enforcement. So what do we have? The Savings and Investments Union, and a very much focus on supervisory centralization. What do we not have in the Savings and Investment Union? Private enforcement. Right? We have, again, public enforcement, administrative enforcement, public supervision. In the action plan and the SIU financial market integration package, which Bart this morning, we were invited again by Hugo for the Ministry of Finance to again hold a talk about the SIU. What is not in these plans at all? Consumer protection in terms of private law, consumer protection in terms of the civil dimension. You all know this. These are now the focuses or main action points, at least for the Savings and Investments Union Action Plan. Reduce regulatory burdens and strengthen EU-level supervision. And when we talk about reducing regulatory burden, we have again a very strong focus on public supervision, administrative enforcement. All bets are again on public enforcement, right? Administrative means all bets are on a more powerful ESMA. What do we not have? Again, in the Savings and Investment Union, civil remedies, damages, rescission, annulment, individual redress, collective actions. All of these points are now, again, missing. And that is funny if you think about what these conduct of business rules for capital markets regulation, where they come from. They were traditionally shaped by national contract law, right? Developed, for example, by the Bundesgerichtshof, the Bond case law. Also English case law, very much focused on suitability requirements and information disclosure requirements, which all ended up, for example, in MiFID. What is here the elephant in the room? Not only in the Savings and Investment Union, private enforcement, civil law dimension. And that has been, I think, a recurring blind spot for the last 6 years. If you start with the Segre report, it focuses very much on what do we need to do? Do we need to find out a sort of a SIC sort of style supervisor? Do we need to find a coordinating council? Or do we have directives that give power to national regulators to try and help us understand what the risks are and try to regulate them? All the way through with the internal market white paper, the ISD, the Financial Services Action Plan, the De La Share report, Capital Markets Union 1 and 2, all missing civil enforcement, private enforcement. There's 2 or 3 sentences about civil private law enforcement in the Financial Services Action Plan, where the European Commission says, well, we have a problem with consumer protection. That is a problem, there's fragmentation, but let's look at ADR, right? Let's try and figure this out, how we could impose consumer protection through ADR. The underexposure of private enforcement is best explained probably by path dependency. We've not been able to harmonize it. Afterwards, we've not been able to change it. Industry lobby has been put forward and advanced as one of the reasons we've also not been able to change it. And of course, member state resistance. It's part of legal culture. And 60 years after the Segre report, you could question now, we're in a sort of a phase of maybe dynamic consolidation, which was overtaken after the financial crisis, of course, where when we first had the MiFID, which came into force, we were thinking, look, how can we improve the system? We seem to be in a sort of similar kind of situation now. And that maybe forces us to look at what we have. A very diverse spectrum in terms of EU capital markets regulation and what we have and what we don't have. We have EMIR on the left side, which very specifically says there will be no contractual consequences for breach of the rules in EMIR, right? And also, if there's maybe a breach, also no damages. We have MiFID 2, MiFID 1, legal renvoi, what the EBI report states, a statutory silence. SFDR, very similar. Prospectus directive, transparency directive. We have some rules in there about private liability, but they don't amount to any harmonization, like Dirk, I think, would say. They say something like, well, you member states must have national law on civil liability that applies. Well, of course, member state law automatically applies, which you also have the CRA regulation. In my car, very, very weird in this sense, but those have very specific rights, damages. And now we also have the Unfair Commercial Practices Directive, and that has a very specific right to damages, which is very important for capital markets regulation, often very much overlooked. It has been used in the Netherlands. It was also implemented as one of the primary enforcement structures for capital markets regulation, and UCPD was implemented as a species of tort. There we had, in the Netherlands, I think we were the only one there that had, if you breach an unfair commercial practice directive norm, which specifically links also to MiFID, the information disclosure duties are included in the annex to the UCPD. If you breach that, you have a tort. I think England had criminal enforcement and administrative enforcement. Germany had a sort of a competition-style enforcement by competitors. We were the only ones with private enforcement by consumers. And that changed with Article 11A, where the European legislator specifically said, well, now you also need to have a right to compensation if the UCPD rules are breached, which is very important because that shows that capital markets regulation is now also possibly enforced through private law. Not only with MiFID, specifically in Annex, it also encompasses prospectus directive, prospectus regulation, it encompasses greenwashing claims, it encompasses information disclosure duties in buy now, pay later, or when you buy a mortgage, or where you have other credit products. And this shows that we have now, also in capital markets regulation, a private law civil dimension style instrument, which is not part of capital markets regulation. Often overlooked, it's now being routinely applied in the Netherlands at least, also in collective actions, and it's now shaping very much how we think of private enforcement of capital markets regulation, because we also have very activist courts trying to look at the European Court of Justice, hoping to have the European Court of Justice try to bail out consumers in very high-profile mass litigation cases. So, European Court of Justice, and this one I will skip, has not given us any clarity in this sense. We have Henio Bank Inter, we have Herman Imofinans, which all say virtually nothing if you look very closely. They say, well, there's an absence of regulation on this, right, in the European Union legislation. For that, it's a national domestic legal order that must assess, determine, and provide for the national law consequences, subject to equivalence and effectiveness. Everyone disagrees on what it means. I think that makes it very clear that it means essentially nothing. European Court of Justice can be seen as holding the line and very much trying to also give maneuverability to give law and change course in other cases. Important case, also not about EU capital markets regulation, QA Mercedes-Benz Group, which is about EU type approval regulation, which is very similar in a sense to EU capital markets regulation, and that it has a public supervisory style enforcement architecture, where the European Court of Justice said, well, no, even despite that, you must have civil law remedies in case of breach of type approval regulation. That might very well, and sits very uneasily, and might very well be translated to EU capital markets regulation as well. And that is, of course, not without risk. So we have, for example, MiFID and Prospectus Directive, where we had very specific decisions and choices by member states not to harmonize further. MiFID II, principle of civil liability, was proposed. It was rejected. Prospectus Directive, there was also a sort of a discussion about harmonizing prospectus liability proposed by the German government. All the other governments said, no, we do not want this. And what now if the European Court of Justice decides very similarly to QB and Mercedes in EU capital markets regulation and MiFID and Prospectus Directive, prospectus regulation, that sits very uneasily about what we should do. Okay, in terms of time. So more harmonization is not obviously the right answer. We have a lot of arguments against this. Differences do not mean obstacles, the limits of private law, what is the steering effect, backfire risk, and then the question is, of course, what can we do? We need to have very fundamental answers to questions as what is effective enforcement, what works, what does not work, what do we want to do, things Dirk also said, what are the objectives we want to achieve that might differ in terms of different areas of capital markets regulation. They all should inform what the EU legislator might want to do. What it does include and what it must include a strategy that not only focuses on harmonization, deregulation, what have you, because it turns out that it's very difficult to harmonize this area of law. Need to also focus on vertical and horizontal judicial dialogue. Preliminary reference, it's very incapable in EU capital markets law, shaping the relation between private law and civil law. We need to have better questions, better references, and we also need to have European national courts understand what they want to do, what information they want from the European Court of Justice, and we need to focus also on this horizontal judicial dialogue. Courts need to understand what they have, their databases, judicial networks, and need to work together in defining what are the questions, what do we need answers on, what are the problems, what are the obstacles, and this could be a combined strategy, and this is what I want to close with. This could be a combined strategy, at least for the European legislator. Think about what you want, what you have, what you can do, also look at the member state, what are the obstacles, how do they work, how have they been overcome, right? Top down with bottom up experiences. Understand what you want to do. Do you want to have something like competition law with a private enforcement directive? Do you want to have the UCPD anchor? Do you want to have an enforcement structure like that? And if it all turns out to be unfeasible, do not just ignore it as the elephant in the room, but also try different ways of having a sort of adjudicative coherence instruments to make sure we have less fragmentation, smarter rules, more intelligent enforcement. Thank you.
Thank you. Thank you very much for a very enlightening presentation, Marnix. I wonder whether this can work with Court of Justice having no interest whatsoever in private law, having shown no interest whatsoever in private law, which I guess is one of the key question marks. Now we move on to the part on the further discussion and Q&A with our further contributors. And I'd like to give the floor first to Emiliano Tornese, who is head of unit at the European Commission and an expert on macroprudential policy. I think that since discussions about simplification inevitably become a sort of party of bashing the legislator, it is only fair that we give the legislator the floor to just defend what has been done and what will be done. Thank you very much.
So thank you very much. It's really a pleasure to be here and to be invited. I have to say the EBI report really enriches the simplification debate with the scientific rigor. So thank you very much for that. Many of you have asked for footnotes, 1, 10. I mean, of course, there is also demand to reduce the length of these reports, so we'll try to do our best. But I see that the report really embed the spirit that really it's in our thinking at the European Commission. The simplification exercise is surely not to increase the requirements. The general assessment is that the requirements are adequate. The simplification exercise may actually reduce some of the requirements, which are duplicative and unduly complex. The objective of the regulations must not be eroded. So many of you mentioned resilience. The resilience of the European banking sector is, of course, a key competitive advantage and the prerequisite for sustainable growth, because ultimately that's the final objective, and competitiveness. So the central question is how to meet this objective in a simpler way, imposing less administrative burden on regulated entities. So let's start with the problem definition. I have to say that recent stress tests and the evaluation of financial indicator has showed that the European banking sector is indeed resilient. So over the past decade, the European banks improved their capital ratios and their asset quality. I have a few slides, probably they will be distributed, but I will mention that here. They are more efficient and cost-effective, and they also achieved record level of profitability. However, despite these solid fundamentals, the European banking sector still faces significant structural inefficiencies. They are still lagging in terms of competitiveness. A look at the price-to-book ratio showed that the financial market priced them at a discount. European banks also struggle to compete globally in certain activities, such like corporate and investment banking. Just in terms of size, in terms of corporate and investment banking, globally, US banks, they cover 45% of the market, whereas European banks only 15% of the market. This lack of scale also impede, therefore, this global reach. And they also impede those investments which are able to allow this kind of a technological transformation. And of course, what is lacking also is a base which is basically a capital market union, a saving and investment union. Just to think about how much is expensive for those banks to finance themselves on the market if you don't have a deep and liquid capital market union underneath. And we can see that also in terms of capital of respective bank. If you compare probably the biggest bank in the US, probably the biggest bank in the US in terms of market capitalization covers the 10 biggest European banks. If you see, and this has grown over the 10 years period. So that's just to give you an idea. So we should ask, of course, what are the reasons? Complexity indeed plays a role, and I will get to that later. But I would like to argue that the most important impediment to the EU banking sector competitiveness is actually the fragmentation of the single market. EU banks continue to operate in a structural fragmented environment despite ongoing integration efforts. There are several reports, the Draghi report, the Letta report. Draghi referred to the internal barriers, the internal tariffs. Let's ask ourselves the question, how much is difficult to make business cross-border? And yesterday there was actually also another event where the ECB, the SSM, clearly referred to how difficult is the cross-border lending. And also yourself, I mean, you're not only stakeholders working in the banking sector, but you're also citizens, customers. Ask yourself how much, is there enough competition there on the market? So that's something that you also have to think as a customer. So first, scale remain a structural constraint, particularly in comparison with the largest global jurisdiction. Second, cross-border consolidation remains limited. So banks find it difficult to expand internationally, and mergers more often take place within member states and sometimes not even within member states. Third, national barriers and discretionary practices constrain scale and efficiency. And fourth, I mean, I will mention divergent insolvency, taxation, supervisory regime, make it very difficult for banks to offer the same product across Europe. But I'm also particularly happy about the last intervention, which referred to, you know, the possibility of every citizen to go and go for a private enforcement. This is also a very powerful tool, also to compare to the role that supervisors could have. So addressing the cause of fragmentation, therefore, is key to boosting the competitiveness so that the banks can actually contribute to the EU economy. We need a more integrated single market for banking, where cross-border business becomes significantly easier and more natural. And we also need to complete the banking union, as Bart was also referring to. So let's focus on complexity. The EBI report speaks about simplification, no? And everybody is referring to that. And is correct in describing that the EU banking sector and regulation and framework is actually overdue complex, also in terms of international comparison. I mean, I have a slide which shows that European banks face 8 parallel constraints, what we call capital stacks, for their going and gone concern capital. So we can concur, basically, that with the EBI report, that this complexity also is the product of cumulative legislative intervention responding to legitimate but with heterogeneous policy imperative. And you refer, for example, to the ESG related disclosure or the governance requirement. So the regulatory process has many players and stakeholders. You have here the Basel Committee, you have the European bodies, member states, ministries, national central banks, supervisor, resolution authorities, banking lobby, to name a few actors. And political compromises are often made at the expense of simplicity. And when it comes to the COP, legislators tend to prefer complex solutions, catering for all possible EU and national specificities, instead of making concession in the name of simplicity. So regarding inconsistency in the legal text and between them, the current size as well of the financial key make it impossible to fully think through and consistently to align all these elements. So it would be nice to look at what has been done so far and to think to a kind of a regulation approach with a more coherent, holistic, and consistent approach. And imagine what are the consequences in terms of compliance costs for banks, but also for regulators. So on the way forward, so simplification of regulation and supervision rules alone will not be sufficient. This must be pursued in conjunction with market integration. Simplification and integration, therefore, should go hands in hands. So we are seeking solutions that operate at the level of the single market rather than purely national approaches to certain issues. A more integrated single market is a shared responsibility, and if we are to compete effectively with the largest global bank in key markets, we must build European champions and scale up. Cross-border consolidation is a key mechanism to achieve these. And I had to say, and the outstanding issue cannot be adequately addressed through a patchwork of minor adjustment. There are also divergent views already now, and we've been seeing through also the many responses that we're receiving in consultation, on what such fixes actually should entail. Whereas if you look at other jurisdictions, like for example the United States and the United Kingdom, they're pursuing banking policy through a comprehensive reform packages and processes rather than incremental fixes. But besides fostering market integration, we also must aim to simplify the legal framework. Many of you have mentioned transforming directives into regulation, which is probably a next necessary step, which absolutely needs to be done. And this, for example, could cover the macroprudential capital buffer, which could, for example, be included into the CRR. This would actually save administrative costs to the EU and national bodies. It would speed up the adoption of the revised rules. To have a single text instead of 27 variants will eliminate the risk of unwarranted national discretion and deviations, which are also part of the complexity. And this is very much in line with also what has been proposed by the ECB. And when considering the micro, macro, and resolution framework, we also intend to look at whether the provision and policy instruments cannot be streamlined. As an example, there is the macroprudential buffer space, which now has 5 buffers, so sometimes they are adopted differently by member states, sometimes to tackle the same type of risk. So imagine yourself the perception of someone who wants to invest in those banks, or just basically the overview of the landscape so far. So our report, and you know very well that the Commission is working on this report, is going certainly to look at this simplification aspect, looking therefore at the complexity. It's going to focus on the market integration element, therefore a way to scale up. It's going to focus on the banking union component, and of course on the proportionality element as well. So in terms of process, we concluded a public consultation. It was quite successful. We had 227 responses, very, very comprehensive, a lot of rich material. We're going to look at it. We're working on a communication report to be published in the summer 2026. Reading the news, it seems that it's going to be published on the July 15, so good to read that. And in terms of legislative proposals, following this communication report, again, reading the news, this should come in the first quarter 2027. So we thank you all also for the engagement. I mean, this is a conference is part of it, and I have to say the report is really contributing a lot, providing this input also from a very, as you said, no political, but also legal point of view, which is absolutely key, I think, because at the end of the day, this is also linked to many of the compliance costs that banks are actually facing. So I'll stop here, and thank you very much for that. I'm sorry, but I didn't have the time to look in the world.
Thank you very much, Emiliano. For these very insightful remarks. And since you close mentioning the compliance costs of the banking industry, I'd like to invite Michaela Zetzsche to the stage so she can perhaps share the perspective of the banking sector of what are those compliance costs and what are the priorities when it comes to simplification.
Oh, hi to everybody. My name is Michaela Zetzsche. I come from the German Banking Federation. We are representing the private banks in Germany. I'm a long-standing member of the Banking Supervision Committee of the European Banking Federation, so this is why I believe I know more or less what the European industry is actually thinking about the situation. Thanks for having me here. I do not intend today to talk about LSIs and the small banking regime. Mr. Binder, I believe you have laid down everything one has to say about the topic, so I don't think there is a need to further elaborate on that one. I wanted to come back to another point. The report, to me, represents a brilliant legal analysis of what has been developed in the last 20 years. I didn't really concentrate on the footnotes, but on the main points, and very often it was just nodding from my side. I have been in the business for 22 years. I have gone through all the development of this, and very often I read it and I thought, yes, this is exactly the point. Since it is a legal analysis, it comes to solutions which are within the context of legal theory. I do not want to concentrate on this today because I think you've done a wonderful job. I would rather want to come back to the political side and also to the industry's behavior, which is also a reason why we are in the situation where we are in. On the political side, Bart has already laid it down. Emiliano also presented this. We do have an institutional problem in Europe. We do have too many governmental institutions being involved in the design of financial regulation. In each of these, and I don't mean just the ESAs or the SSM or the SRB, I mean all the local institutions in the different member states. I cannot remember the exact size. I once heard it was much more than you would expect to have in 27 member states, because each member state has a different form of how to decide on the macro buffers or how to decide on the resolution rules. So it's a vast number of institutions. In all of these institutions, there are clever people sitting. They have a task. They want to fulfill their tasks. So that's what they are doing. 2 days ago, we sat together with Patrick Amis and discussed the simplification agenda of the SSM. In the meeting, he explained that there are 178 DSIP buffers in Europe. So we have 178 national champions in the EU. Or do we have a few national institutions wanting to use the toolbox, which we have been providing to them in the recent years? The macro buffers, he said it down 5 different things. The systemic risk buffer, it's a wonderful, do you know the discussion we have on the counter-cyclical buffer? It's the same legal text. It will not help to transpose it into the CRR. It's a good idea, we can do it, but it's not going to help because already now we have one text on the counter-cyclical buffer, which is pretty clear, and still you do have EU countries where they believe that there has to be a constant value, and there are others, like Germany, which say it can go down to 0. It depends on how you want to interpret it. You are all legal academics. Do I have to explain this to you? It's not. So the problem we have to tackle first is the European institutions having been created in order to reduce the problem we are having. That's one thing. So that's the state. So now the industry, that's us. I have been sitting in so many self-help working groups on regulatory rules you cannot imagine. And it was always the same. I call this betreutes Lesen in Germany, in Germany, that you help you read the text. And then after a while, there was and what is this supposed to mean? I need more clarity. My auditor comes along and tells me this and this and this. How can I defend myself? The regulator interprets it this way. How can we regulate this? We need more clarity. We need to alter the text. We need to have examples. We need to have this and this and this. And this is why we have these 1,000 and something Q&As at the EBA. We have these extensive level 3 guidelines, which are actually a means being created by the supervisors to discipline themselves to come up with the same harmonized approach toward things, which in reality does not help. If you talk to different European institutions, you will find out, of course, there are differences in the way GSTs treat them or the national supervisor treats them. More text does not create more clarity, but it's us screaming for it because, as you said it, I really liked your sentence, we don't want to take on the responsibility. It's really easy to push it on to the supervisor. So what happens in my association if I want to get a decision? I have different ways of doing so. I first talk to my working group, okay? Then I can talk to the next level, and finally I have my CROs. If I come with abolishment in the working group, then it's maybe this, maybe this. No, this is good for clarity. No, this is I want to keep. So I go a level further. Yeah, abolishment is good, but there we need clarity. No, I have voices in my house, they want to keep the rule because then they can defend. Huh? So, but if I really want to circumvent them and get rid of the rule and go out there and say to the supervisor, please abolish the EMA risk for the significant institutions, then I go up to my CIOs. They have no scruple. They say, what? Gone with the rule. So it's also us creating that mess. These are the two messages I wanted to deliver today. I don't have the solution. I only can tell you that I don't have the solution. I only can tell you that I'm now sitting in a lot of working groups trying to simplify rules. The latest I was in was on the radar guideline. It's a very technical thing of the SSM, but it causes a lot of trouble. Huh? And also there, I keep on singing the song, if we want to come down with the letters, and if we have to go back to more principle one, then there needs to be less clarity. You will have to live with less clarity. You have to take on the responsibility, and you have to make your own decisions and defend them with your auditor and defend them with your supervisor. Sometimes I succeed, sometimes I don't. That's all I wanted to say.
Thank you very much. That was really refreshing. As you said, we are legal scholars, so we try to bring home the point of the legal technicalities, but it's always good to remember, to be reminded that all this is the product of a process that sometimes is the process that is skewed and towards creating complexity and lack of accountability. And so I think that was also part of the point that Dirk was making and the point that Bart was making. Then lastly, but not leastly, I wish to invite to the stage Fabian Schildner, who has been one of the coordinators of this report with us. I think that we have heard plenty of things, sometimes in line with the report, sometimes misaligned with the report. I guess that you will have seen some of the things that, some of the arguments that are close to your own interests. So I guess that you can offer some additional reflections so that we can bring home some of the basic points. Fabian, the floor is yours.
If I may, and the fact that Fabian was so much involved in this work did not prevent him from the time that he started the work until we published the work to defend his PhD thesis as well. So he joined the group as a doctorate candidate, and now he's Dr. Fabian Schindler. Yeah?
Thank you very much for these kind words. Indeed, it was a lot of work, especially in the finishing stretches of my PhD thesis. But I'd like to begin with to thank the organizers of this conference and all those who have participated in writing and commenting on the report. I reread it on my way here to Brussels, and I think it turned out excellent. Yeah, we raised many very important issues. So thank you and congratulations again. I'll try to keep my intervention short and simple, and I've only prepared 2 talking points. Yeah. The first one is clarity in writing, and the second one deals with that simplification is a matter of mindset as well. The first is already in the report, and the second came to me actually during your keynote speech, Dirk Zetzsche. So coming to the first might be a little bit academic, but I also think it's a great matter for business. Yeah. We need to improve the clarity and comprehensibility of our legal texts. Yeah, I think one of the best examples out there is MiFID II. In MiFID II, for instance, in Article 27, there is a rule on best execution. It's very long, it's very dense, very technical, and very hard to understand. And I think it's no shame to look at other countries, what they've done in the area. And some have done much better. For instance, if we look to Switzerland, they have dealt with the very same issue in Article 18 FITLEC, which is basically MiFID for Switzerland. but they've done so in 3 sentences only. The EU took 5 times as much, yeah? And their rule works very well in practice, yeah? And what I understand from my Swiss colleagues and friends, to name one, Rolf Setes, they do this through very careful and diligent language review, not by lawyers or economists, but by people who actually study languages. And I think this works out very well, and the EU could learn from this experience. And second and last, and I think this is a very understated point, simplification is a matter of mindset as well. Yeah? And Dirk Zetzsche, you mentioned it in your keynote speech, regulators fear what they do not know. And when they do not know, they regulate because they try to stop the risk before it materializes. And I think that's a major issue. So what I'm trying to say here is that people, for instance, like me, we see the world in risks. And when we see those risks, we tend to over-regulate. So people like me, for instance, wouldn't be a very good regulator. Yeah? So how do we change this? And this is maybe a question also to the audience and also to the panel. Maybe someone here has a better idea than me, but what I came up with during your presentation was maybe we can change the goal of our ethos. Yeah? If we look to the US, for instance, the SEC, it does not only deal with protecting investors and market integrity and financial stability, but they also have as a key goal capital formation, meaning moving money from households to businesses. Yeah? And what we could do in Europe maybe as well, yeah, is also to incorporate this. For instance, I don't know, in Article 8 of the ESMA regulation, to add this, yeah, so they can, what I do mean is not that they actively try to take money from households and move it to businesses, but they consider it in the legal analysis very carefully and much more than they do now, yeah, and use maybe also their discretion in interpreting certain rules, so they better fit with the goal of capital formation. Or, if it doesn't work out, suggest to remove the provision altogether, as Dirk mentioned, targeted deregulation. Yeah? So my first point was clarity and comprehensibility, and my second one was mindset. And I'm very much looking forward to also hear your views on these matters. Thank you very much.
Thank you very much. How are we doing on time?
We still have, I say, 10 minutes.
Okay, so
allow me, however, to respond to a point raised right now,
okay,
which was raised also by Dirk, and take the example of Switzerland. I'm not an expert in Swiss law, but I understand Swiss law. You made the distinction correctly, whether we need rules or standards. I could rephrase it and bring it to your proposition, whether we need principle-based regulation or rules-based regulation, correct? And Switzerland is apparently a very good case for principle-based regulation, even though 2 of its largest banks failed, yeah? But still, this was not due to good or bad regulation. It's not time to discuss that. My point is the following, question for consideration. It may be the case, yes, that we need principle-based rules. And as a matter of fact, I have counted it. The banking Gesetz, the banking law in Switzerland, contains, if you clean them up, 130 articles. And this is the combination of CRD4, CRR, BRRD, Deposit Guarantee Schemes Directive, which is definitively more than 1,200, yeah? So we have in 120 articles what we have in the European Union in 10 times more, yeah? The FIDLEG is another one, the FINFRAG is another one, and so on. However, there is a difference. Switzerland is a federal state, and the rules apply as such to all banks, no matter whether they are based in Basel, or in Zurich, or in Lucerne, or in Geneva. If you apply principle-based regulation at the EU, the risk arises, food for thought, and thank you for reacting immediately, that the interpretation on the way that the principles would be applied in the different member states could lead to divergence. Yeah? This is not an alibi for why we have all these complex rules, but explains to a very certain extent that when you say that market abuse is prohibited, yeah, you need also to prescribe how to do it. Otherwise, you may end up with 27 different market abuse, investor protection, resolution protection, whatever frameworks. And this is exactly what we are trying to avoid in the European Union, despite the fact that I agree with Dirk that not only supervisory competition, but also regulatory competition may be of benefit. But however, if you compare a federal state like Switzerland or a state with the European Union, you have this key difference which explains why our legislation is so larger, which it should not be so much larger, but it cannot be so lenient as one in Switzerland.
I think that Bart was asking for a quick reaction to this, very quick, and then we can give the floor to Dirk. Quick reactions, please, because we are now in the last stretches.
So experiments with legislation. I always say also look at let's say historical experiments with legislation that have found place in. I'm a little bit older than most of you in the crowd, but the member states have had their experiments with principles-based legislation in my country, for instance, and it ended up basically that, very surprisingly, particularly the smaller and medium-sized businesses in the financial sector didn't like principles-based law. Why? Because it ended up in extraordinary expensive, basically expensive staffing of the bank, because they needed to start hiring 10 compliance officers instead of 1, in order to make sure that the interpretations that needed to be given by the smaller institutions were well reasoned and subject to debate and so forth and so forth. In academic literature, there's also been really a lot of research on the effectiveness of principles-based legislation. And Julia Black, one of the most prominent researcher in that respect, UK Cambridge, I believe in Cambridge professor, basically, was initially, together with their research groups, very much a supporter of principles-based regulation. And after the financial crisis, basically in 2009, she wrote a very nice, very long, well-founded, basically, articles that say that principles-based regulation has failed and was not effective to prevent the financial crisis, and has something to do with the responsibilities that are laid in the hands of the banks and the financial institutions, which had been difficult to take up. Yeah.
So, yeah, I think that we have pointed to the cost of producing legislation and the cost of applying legislation, and at different times in time, bonanza or crisis, we tend to overestimate one or the other depending on how the winds are blowing. And I guess that this is a good reminder of that. I think that Dirk wanted a quick reaction.
Very quick point, and that connects a little bit your presentation actually to the remainder. The difference is not in Switzerland that they are homogeneous. Of course, Tessin is different than the Wallonian cantons and the Germanic cantons. The difference is maybe a broader federal jurisdiction of the court. And now we're getting back to you. Maybe we have to think either about broadening the jurisdiction of the European Court of Justice to get better case law, if we deviate from the rules-based approach, or, and then maybe an alternative which is quite cheap and possible today due to the technology, accepting the case law of other countries as precedent in our respective court system. Yeah, and that would require today, in the past, languages were a problem. Today we have DeepL. It's not a problem anymore. What is lacking is a database. Yeah, we would need a coherent database, and maybe the gentleman from the European Commission, if he's still there. No, okay, then this is productive.
Yeah.
Okay, good. No, but this would be the idea, to have a kind of pan-European database of countries' courts. And if we would get into this tradition, then we would probably be better able to deal with principles, because there's one thing besides Julia Peck, there is evidence from sociologists and from psychologists that ethical differences lead to different application of laws. We can have always the same word. It will be understood differently. And so like terms like bonne foi, good faith, treuer Glauben, is something entirely different depending on your ethical background. So the same words will not make the difference, but maybe this kind of precedent idea, that could make it.
Thank you very much, Dirk. I think that we are close to closing. Do we have a couple more minutes, or how are we doing on time? Yeah. So just to, by way of closing remarks, and we go to the break, I believe that we have covered a lot of terrain when it comes to the legislative process of producing norms, but we come inevitably also to the part where norms have to be applied. And I think that is something that has come across transversally quite nicely. I appreciate this, considering that I have also advocated for a system of courts with commercial background that help unify and harmonize private law across the European Union. And I have also advocated for a court of justice that for once is a bit more interested in commercial law matters, because if it is something that characterizes the Court of Justice, is that it is a public law court. It is a public law court with the public law mentality, which when comes across an issue that raises matters of private law, including enforcement, tends to look at it from the lenses of a public lawyer, hierarchical principle, financial stability trumps investor protection. Santander saga, does it ring a bell to anyone? So I think that this is also a refreshing perspective, that not everything can be done by the legislator and in legislation. Some food for thought. So thank you very much to all the speakers. Thank you very much for Jens, who is with us also online. And, we can continue throughout the coffee break. Thanks a lot.
So, thank you very much for being back in this event. The second part will be more on the institutional framework, how it has evolved, what can be done in order to fix it. We have discussed it partly in the first session, but now, so to say, the Lamfalussy process is our key animal, yeah? And I wouldn't think of anyone better than Filippo Annunziata to make an introduction to this, followed by another Filippo who will do that. And I jokingly said today, we don't have a third Italian because Antonella could not make it. So otherwise, it would be a Spanish and a Greek coordinating Italians. And it would be mission impossible, yeah? But still, we are very much missing Antonella, who had to sit in a meeting of the Constitutional Court today, so she could not make it. But then we have more interventions. Filippo, let's give us the opportunity to beat you.
I do have some slides, but first of all, thank you everybody for inviting me and for being ready to tolerate my speech. I'll try to stick to the 20 minutes and to have a bit of discussion. It was a great pleasure to contribute and coordinate with Christos and the report. I was also one of the people who worked on the less is more report that came out before, the EBI report. In the meantime, I published a paper of mine that engaged in an extensive distance dialogue with Dirk's paper on deregulation. And I won't repeat here what I have already written, but just to say that I'm going to say something slightly different. I'm not going to present or comment on the report, but I'm going to address the problem of simplifying the lawmaking process in EU financial legislation, and naturally the topic we're talking about is Lamfalussy. Now, the Lamfalussy process is now 25 years old, so it's not a baby anymore, it's not an adolescent, it's an adult, but it does show different points where we can think of looking at it and improving it. Let me see if this thing works. It's supposed to work because it's giving a green light, but the slides are a bit stuck. Okay, yeah, okay. So I don't want to repeat what the Lamfalussy stuff is about. Most of the things I'm anticipating, I hope I have the energy and the time to consolidate it in a paper, maybe an EBI working paper, and then see how the debate goes on and transform it in something more structural. But if we look at what is not working in the Lamfalussy process, which is just one of the areas that make EU legislation problematic in its making, and not just in its making, but in its enforcement. I don't have the time to talk about everything. I just decided I would pick out Lamfalussy. It's a good point of observation. Most of the things have been discussed in the report and also in the less is more and also in literature, and they point to, I think, 4 more structural fault lines. The first is the norm density fragmentation. So the compromise, the political compromise that we reach at level 1 in the Union defers a lot of technical consent to level 2. Dirk was pointing right in that direction. This is because there are political compromises, but we end up with a level 1 that, apart from being principle-based or not principle-based, and Dirk, I fully agree with you, the problem is not principle or granular or rule-based, it's clarity in the formulation of these norms. Because even if when we have level 1, which is far from being principle-based, and it is already contradicting the original Lamfalussy, when it is already prescriptive, we have tons of level 2 and level 3, and it's like a dark well. You never reach the bottom, and you're always left with the question, how do we interpret this stuff? I used to be very confident until 10 days ago as to the role that the Court of Justice might play in clarifying and cleaning up the dark waters, but I am now in a period of deep depression, so I have to breathe and think that there is the sunshine. When I read the Brannelius decision 10 days ago on the definition of what is a public information under insider trading legislation. 10 seconds of silence are enough to express my dismay and my drop in confidence as to how the Court of Justice might be able to deal with these intricacies. So that's the first point. And level 2 also is there. Sometimes level 1 does not even enters into force, but then level 2 technical standards are approved after the entry into force of level 1, and this leaves a gap that is one of the points I will try to address. And this leads to temporal dislocation. Level 2 measures are sometimes finalized after level 1 obligations apply. And then we have the whole universe of non-binding, allegedly non-binding. Level 3, we have the guidelines. They have the complain or explain mechanism. The FBF judgment confirms that they create no binding obligations and that the comply and explain mechanism has no hardening effect, even if, in my view, it does have a hardening effect, very strong. And by the way, this on clarity leaves a lot of supervisory divergence in place. And then the topic that was extensively discussed in the Less is More report, and that is also rediscussed in the EBI report, is the problem of democratic accountability deficit in level 2 and level 3. In my paper, I'm sort of thinking of having 3 annexes where I provide concrete examples of these mismatches. I have no time. I don't want to lose your time or to steal your time in going into the intricacies of this, but one area is AFMD, where we clearly see that there is this sort of implementation gap between level 1 and level 2. There are some very important technical standards that are still missing, although the level 1 is already in force. The second area is naturally, this is fun because you have so many examples here that it's just, just have to pick one out of the pot and it works, like CRD and CRR complexity, and the level 3, the other area will be insurance. So I'm not missing anything. I'm not sort of favoring one sector vis-a-vis the other. It's a cross-sectoral issue, this mismatch between level 1 and level 2. And I will comment extensively in my paper by providing 3 annexes so that I do not stuff the main paper with too many information. I leave them in the annex for people who are interested in looking at these examples. So let me start from the last point that I touched upon, level 3 soft law proliferation problem. One way in which we could improve this level 3 and effectively improve the quasi-legislative or the legislative process is to try and put this level 3 a little bit into order. We have the Article 16 guidelines, we have the Q&As, we have the supervisory briefings. The first issue I see here is that there is no clear hierarchy between these different levels of these different sources of soft law. Guidelines have this this hardening effect of the comply or explain, but they do not necessarily sit at the top of the hierarchy vis-à-vis Q&As or vis-à-vis supervisory briefings or other level 3 tools. For instance, in the Q&As, we have two different kinds of Q&As. The first ones are the ones that require actually interpretation of European law. And this is where the ESAs have to ask for the Commission's imprimatur on the basis of Article 16b5 of the founding regulations. But these sometimes are the most disclaimed. They come out in a way that sort of doesn't really entirely clarify what we're talking about, evidently because the Commission is rightly afraid of the Court of Justice, maybe because the ultimate word as to interpreting European law sits in the Court of Justice. And again, the Brunelius case is another clear example. The Advocate General did a great job in showing that the interpretation of what public means under the market abuse regime has been clarified over and over again by ESMA's guidelines, Q&As. The Court of Justice doesn't even cite the existence of those level 3. But for more than 20 years, the market has behaved as though those soft law tools were in some way indicative, at least, of supervisory expectations or market conduct. And the topic was not forgotten. It was clearly set in front of the Court of Justice by the Advocate General, but the decision is completely silent, as if level 3 tools did not exist. So even when the Commission has to give its imprimatur, there is a bit of sense of fright of being really clear-cut as to the interpretation, maybe because the Court of Justice might overrule in the meantime. And we see that in capital markets. We now have quite a number of cases coming up, so it's not just banking law that's being challenged in front of the court, but this week, I think we'll have another important decision from the Court of Justice, also coming this time from Germany. The Bundesgericht has raised a very important preliminary question on the actual knowledge of inside information coming from the Volkswagen case. And I'm looking forward to this decision and see what comes up. The other guidelines circulate without equivalent disclaimers. And then we have supervisory briefings and the other stuff. Now, one suggestion might be to rationalize the level 3. And I have here 5 proposals. They are not entirely mine. They have already maybe been set out in the debate. The first is maybe we could refine the founding regulations of the ESAs to define better each soft law category's legal status. I know I'm touching upon Meroni and Romano here, but I'll go to Meroni and Romano in 5 minutes. We could clarify better the production process and their normative effect. We could maybe clarify and state very clearly that Q&As are explicitly non-binding, so as to deprive them of some kind of ambiguity, especially for the ones that require the intervention of the Commission because they actually provide interpretation of European law. And we could maybe think of barring NCAs to cite these Q&As as the basis for their supervisory activity. And I would like to carry out our research and to see how many cases we have. We have some cases in Italy, for instance, where our supervisors do cite the Q&As and the ESA soft law as a basis for their supervisory action and even enforcement. And we also had some litigation in front of our administrative courts that is sort of challenging whether this works or not. The second thing is consultation. The body of soft law is increasingly complex, and maybe we could have a register linking every soft law instrument to the binding text it addresses, and there is some need for improving the repository of soft law measures here. When we have cross-sectoral issues, these maybe should be mandated to the 3 ESAs, and we may ask them to provide a sort of an annual soft law coherence report to the European Parliament or to the European Commission. It would be interesting to see what comes out from this annual review. On Q&As, again, maybe we could distinguish between different types of Q&As, some of them requiring board endorsement, others more expressly qualified as informal guidance with clearly stated no supervisory or normative value. This could be something that clarifies better the nature of the Q&As. And after 5 years, we might, maybe 3 years, 5 years, a sunset clause. Why should we live with a world of Q&As that in the meantime has been superseded by level 1, level 2 changing, and several Q&As that we find, and also guidelines might in the meantime and effectively are superseded, and this could be one idea. And then, I know this is very difficult, but we keep on saying that all the time, we have to take seriously the problem of Meroni and Romano. I mean, if these are two doctrines that are clearly outdated vis-à-vis what we have in mind in relation to the landscape of EU financial legislation, we should take this task into our hands. I know it requires a treaty amendment. I know it requires additional efforts, but this is something that we have to work on. And maybe the voice of the academia could be more clearly heard, because if we start sort of putting ourselves together and really claiming and shouting for Meronian doctrine and Romano to be reconsidered, we might produce some effect. We've been a little bit too soft in looking at the recent developments of Meroni and Romano. And again, here, the Court of Justice is a bit unclear. Sometimes they say clearly that Meroni is live and as lively as ever. Other times they simply forgot about it. For me, at least, maybe I'm mistaken, but for me, the fact that the FPF decision, which is about Meroni, doesn't even cite the existence of Meroni, is disturbing. And so it was even more disturbing when I saw Meroni emerging again live as ever in the resolution cases, right? As a justification to the fact that the SRB cannot do, etc., etc. So either it's dead or it's alive, but to keep it there as a ghost, appearing and disappearing according to the political orientation of that particular decision of the court, and I say political in good terms, but it's a political orientation ultimately, is not the right way to proceed. So we have to take that into account. And then we have this problem of methodologies that are sort of being exported from one sector to the other. I refer here to the ambiguities of the AMLA regulation that imports a lot of methodology from the SSM, including the distinction between EU direct supervision and national supervision, and in this context also imports critically what could be a very important tool to improve the legislative process in the Union, which is the application of national law by EU institutions or authorities. Now, we know that the tricky part here is twofold. On the one side, we have Article 4.3 of the SSM regulation that was envisaged in the context of that setup, and this is managed by the ECB, which is an institution which doesn't really have to consider Meroni or Romano, and but even in that case, the application of Article 4.3 by the ECB and the way in which the court has handled the several cases that have been raised as to how this application should take place really show a high level of uncertainty. But then if we transplant this tool into the context of an agency, the AMLA regulation, things are even more complex because, unfortunately, the AMLA is an agency and not an institution. And now, from what I read in the market integration package of the Commission, one of the proposals is to extend in some way a similar mechanism to ESMA. So One problem that we have is that we do not learn from our mistakes, and we keep on repeating them and even aggravating them, because the jurisprudence on Article 4, Paragraph 3 is really extensive, but it shows how ambiguous. It's a very useful tool for market integration and also for uniform application of EU law, but it's been handled in different ways, and we do not have a clear line of conduct in the context of the SSM. And think about when this stuff starts working in the context of an agency that is subject to Meroni and Romano. But in the meantime, we are extending it to the ESMA. So one thing that is missing is some kind of comparative approach between the past experiences and what we're doing now, and serious backgrounding what we have learned from our mistakes and what mistakes we should not repeat. Another problem where we can that we can look at in terms of improving the legislative process in the Union is how we implement international standards. Now, this is a topic which is very dear to Christos, so you know exactly what I'm talking about, and the way in which the timing and the way in which we implement international standards might be improved, because the Lamfalussy level translation of the international standards, such as including capital markets, last but not least, IOSCO, Financial Stability Board, and so on, goes through various phases that provide various opportunities for Europe to gold plate, so to add further layers going beyond the international standards. For example, in Basel III, we have quite a number of examples there, or gold stripping, omissions or dilutions of prescribed standards. So we end up with divergences, and these divergences are already in level 1, but they cannot really be filled at level 2, 3, because they fall outside the mandate of the European agencies and of the European Commission. For instance, the MiCA regulation was agreed before the FSB and IOSCO provided their recommendations on crypto asset legislation. And the FSB's report of October 2025 clearly points to various areas for improvement of the MiCA package in relation to those recommendations. This is one of the many examples that you can make. A further area of improvement might look at the dispute resolution mechanisms. Dirk has already talked about that. We have three main provisions in the founding regulations. We have the procedure of Article 17, breach of European law, articulating emergency powers, and the binding mediation procedure. And some suggestions point to strengthening these three tools, especially the binding mediation, which currently, it hasn't really been tested much. The case that Dirk was referring to was a very important case of a mediation in relation to UCITS and crypto assets, but it's not really working as it should, also because it depends mostly, if not entirely, on NCA voluntary self-referral. The market integration supervision package looks at centralizing supervision in capital markets. There might be a lot to say there, but what the market does is not really solving anything about how legislation is produced, doesn't say really anything about what we're talking about, level 2 and level 3. And so again, it is sort of adding a further layer of complexity that I think I will discuss in my paper. Now, 10 proposals to sort of close my speech. 10 out of many. Anybody, I think, here has in mind something that we might discuss. The first is that really I would suggest to have mandatory level 2 timelines. So level 1 text could have adoption schedules for level 2 measures, and provisions of level 2 should enter into force, of level 1 should enter into force only after adoption of level 2. That's not very difficult to do, right? It's good management, it's not so conceptual, but it might improve the system that we are living in. The second is maybe thinking about a negative endorsement model, so that the proposals of the ESAs are automatically there in place after, well, I say 12 weeks, we can say 50 weeks, I don't know how many weeks we need, if the Commission does not object. And this might speed up the level 2 without really infringing on Meroni and Doctrine and Romano, because we have to keep those in place. Naturally, the next step would really be, let's think about simply dropping the Commission approving the technical standards, but there Meroni and Romano come up and we cannot do that. Soft law taxonomy clarification, I think, is necessary. Streamline that, and the sunset clause might be something that we can put in place without too much difficulty. Decide on a common methodology for application of national law at EU level. Learning from the jurisprudence of the Court of Justice and see whether from the different cases, starting from Crédit Agricole up to Corneli and so on, we can actually move towards an agreed common standard in relation to this stuff, since it is spreading and circulating in other fields beyond beyond banking law. And there are several proposals that are already in the market integration package as to the reform of the governance of the ESAs, and also of appointing, of sort of revising the mechanisms to trigger the mediation procedures and the other procedures under Article 17. One of these proposals points even to setting up a panel of independent experts that would be appointed by the ESAs to conduct investigations under Article 17. I'm not sure whether this is something that makes sense, but I found this in the current debate.
What's independent?
That would need to be defined. That would need to be clarified. Maybe Article 17 could be, the mediation procedure under Article 19 could be made sort of mandatory. On the governance reform, I refer to the market integration package. And the level 2 completeness assessment test is another suggestion, and subject to even an annual review to the Parliament. International standards is something that we talk about when we sort of are in the process of adapting EU law to international standards, but I feel that we need to put in place a sort of an ongoing review as to how we do comply with these international standards, cutting out gold plating, but also the opposite phenomenon. And then the treaty reflection on Meroni and Romano. Okay, so these are just 5 cents to provide some easy, I mean easy because we do not necessarily have to change the treaty, not necessarily. So some suggestions that we can consider to improve, to answer the question that I have been asked to address. How can we improve the legislative process in Europe, starting from Lamfalussy? 25 years, now it's getting really adult, and what we have in front is very different from what we thought we would have had in front in 2001. 25 years ago, we thought that Lamfalussy would be an architecture that would support market integration, further harmonization of European law. It would sort of cut the temporal lags in implementing international standards, in adopting EU legislation, and most of these things have been not really forgotten, but superseded by an evolution that now requires some kind of revisiting. Let's say that Lamfalussy needs a checkup, just like human beings, right? We need regular checkups, and as we grow older, checkups should be conducted more frequently. And now Lamfalussy is moving. It's not old, but it's not an adolescent anymore. It's not a teenager anymore, and it does need a thorough and very reasoned checkup. So I think it's all for the moment. Most of these arguments will be developed in the paper, which is sort of halfway through, but I need to work on it a lot because it covers very different topics, and I run the risk of being too dispersive in what I'm saying. But in any case, thank you for the moment.
I always thought Filippo is a good friend of mine, but you see this guy, huh? He ended up saying that older people, knowing that I am the oldest here, need a more frequent checkup. Thank you very much, Filippo. I mostly appreciate that, yeah. If you allow me, I will take 3 minutes out of Emilio's time, because Emilios unfortunately could not make it today. He apologizes. Because I think that there is one point on which we might need to reflect further on the basis of your presentation. It's not about level 3. The level 3, you may agree or disagree. I'm very much in favor of soft law. You know that. We may not fully agree, but I think that the role of, in particular, the ESAs is very important in that respect, because at the end of the day, they are the experts. What my key consideration is about is on what you call here the negative endorsement model. Unfortunately, the situation is much worse than you have very well presented. Yeah? Let's take an example. You have a legislative act, CRR, MICAR, because in MICAR we also have 2 cases where it's blocked. Yeah, still. Yeah. You have the legislative act which gives a delegation to the Commission to adopt a delegated act based on Article XYZ. There are 2 paths. One delegation is given directly to the Commission without the intervention of the ESAs. Yeah, this is also the case. For example, in MiFID, more times the delegation is given directly to the Commission rather than through the ESMA. Yeah. But in other cases, it may be that you have a delegation given to the EBA, for example, to the ESA, to adopt draft regulatory technical standards, which will then need to be approved by the Commission in the form of delegated acts, which will then need to go through the scrutiny procedure. Meaning that once the regulatory technical standards will have been approved by the Commission, they will have to be further approved, finally, by the non-objection procedure, by the Parliament or the Council. It doesn't need to be both. Yeah, they need to be both. Both have to approve them, but each separately by a non-objection. So, as a matter of fact, from the time when the legislative act has been adopted, you have a pipeline which may end up 2 years, and that's the problem, in my view. So, your proposal, and we may develop that further together, yeah, should be that you need to streamline all this, yeah, not only in relation to the interaction between the EBA and the Commission, but also to the end result. And we know very well that when you have all these interim periods, yeah, people love to intervene, be very, very politically correct, yeah? People like to intervene. They know that there is a place for intervention. And we have seen that. I remember in capital markets law, there was a case 2 years, if you remember that, in the PRIPS regulation. Yeah? It lasted, for the ESMA, it lasted 2.5 years, twice back and forth. We have it now in MICAR. Yeah, but, you know, that's very good, but we could experiment before we adopt a legislative act. That's my proposal. Yeah, it's better to have the whole test being conducted before you adopt the rule, instead of having the rule being adopted and then being in a limbo situation. This is my consideration. So this procedure, yeah, Filippo, that was the comment I wanted to make.
You're perfectly right. It needs to be streamlined better.
Across the board.
Across the board.
A second point that you raised, and I close it here, relates to the international financial standards. And you are correct, it's in my heart, because you know that I'm not a company lawyer, I'm an international lawyer, so I'm interested about international financial standards. Now, here we have another point of concern. What should be included in level 1 and what should be included in level 2? When I see all these, you know, my typical case is all these articles, yeah, 325 going on, yeah, with mathematical formulas of 3 pages, yeah? Is this law? Would the Swiss have that in an act? No way, yeah, they have Rundschreiben, huh? They will settle it there, yeah, in Rundschreiben. So we take over the international standards because these mathematical formulas are part of Basel 3, 4, 5, 6, 7, like Rambo, yeah, whatever, yeah? And then you take them over in the legislative act. Why? I always wonder. I think I know, I have given an explanation, yeah? We have it also in a footnote in our report. I think it has more to do with the way that a delegated act could be contested before the courts or legislative act. But still, we have a lot of technicality, which is definitely not necessary in a legislative act, and which is a byproduct, a child of the implementation of international law. So, on the basis of your remarks, just 2 points for further consideration along the lines that you propose, and I fully agree.
Yeah. But I mean, Dirk said it very well, and I hope I repeat it as well as he said it. One of the main defects of what we're talking about lies in level 1, in the way in which level 1 is construed. Because the impossibility of finding a political agreement, but sometimes even of understanding what the legislator is writing, these topics are very technical, right? So maybe level 1 is not even the right place to discuss about the formula, leads to level 1 sort of washing its hands from resolving problems and then sending that problem to somebody else, be it the Commission or the ESAs. And that's where the whole mess comes from. Part of the mess, at least, the way in which I see it, because the legislators should take accountability for legislation, right? And that's where level 1 is faulty. It gets ambiguous, either because it wants to cover everything and then it delves into technicalities that simply mess it all up and lead it to being far away from what poor Monsieur de l'Infalussy thought. Or rather, it gets too vague because of the impossibility of finding an agreement. And so how do you get out of that? You simply leave the problem to somebody else. But this has a cascade effects, and we see this now very clearly.
David, do you want to intervene here?
Just a few remarks of my own. I think that a lot of it has been said, but I wish to dovetail with something that Filippo just mentioned. We often focus on aspects that can be criticized, the presence of soft law everywhere, but soft law is always a symptom. So it is not the cause of the problem. Sometimes soft law is the only thing standing between the market and chaos. And the chaos was created in the first place by a faulty legislative process. So I think that we need to reflect back on what went wrong when level 1 was being produced and when the decision of what went in level 1 and level 2 was being taken. And I guess that what this reflects, these sprawling pieces of legislation show, is a lack of trust in the application process. I think that is definitely what has changed over the past year, that there used to be an overall understanding that the legislations would be more or less balanced or not, the process would be trusted. Eventually, someone would apply the rules in a certain way, and if there was something wrong, it could find its way towards the Court of Justice, which would correct the interpretation, right? So that's more or less the pre-crisis consensus. But now we don't have that. We are always in a hurry. We don't trust the process. And since we don't trust the process, we want to put the bandage before we get hurt. So everything has to be in the legislation. And since it is not possible to find clarity because of no one wants to be accountable, but also sometimes because there is no clear consensus as to what the solution should be for certain problems. I think that the two causes are there. There you end up with regulations that between the choice of being long and clear and short and ambiguous, they are long and ambiguous, which is the main problem. I think that both choices are correct. So you can be long and clear and short and relatively ambiguous, leaving it for the application process. But the problem is that we end up with the worst of both worlds because, and this is the important thing, this is what we are asking our political masters to do. So I think we ourselves should take part of the blame for it, because everyone has a strong opinion on everything, even on the minute details. And everyone criticizes the legislators for not taking up this solution or taking this other solution and so on, which undermines the whole process. I think that we ourselves are partly to blame for undermining the whole process because we don't trust the process in the first place. And I think that is part of this sort of acceleration, this anxiety of expressing opinions as to something that is utterly right or something that is utterly wrong, when in fact the most candid answer we could give on many aspects is, we don't know, let's try this, but if we are wrong, then we will change it in the following years. So that's probably the main remark I have to offer after your very insightful presentation.
We covered the absence of Emilios, and we give Filippo the floor. Jonathan, I see you collecting comments, yeah? Because you are the next one here, yeah? Filippo, are you sitting with us? Please. Don't you want to go?
No, I stay with you. Okay, it's already afternoon, according to the UK rules. But thank you, first of all. Really, let me say thank you to Christos for the hard work that you do every day for the EBI Academic Board. Thank you, David, that in Christos' word has done the hard work for the report. So we have testimony. And thank you to the representation of the state of Hessen, to the EU, and all the staff that made this event amazing. And thank you to Filippo A. for a... Yes. No, but Filippo Annunziata is very important in Italy for our legal sector. And as every time set a conceptual stage for what I'm going to say, I hope in the same stream, we will see. And Filippo has done with his usual and insightful punctuality. And finally, let me send a special and warm greeting to Emilios Avgouleas. Before turning to my own contribution, let me also acknowledge the pre-conference meeting held yesterday evening in this same building. The title was Meaningful Banking Regulation and Supervision, but streamlining, as Christos already said before, streamlining the rules. It was moderated by Thomas Gstädtner, because I don't pronounce German, as you know already, and Minister Lorz, and unfortunately, Mr. Aga and Ms. Donnery. That session, yesterday evening, deliberately scoped its focus to the political, legislative, and supervisory dimensions of the simplification project as it bears on traditional banking regulation. What I would like to do today is to extend the same diagnostic logic to a domain that was, by design, outside the scope, and to draw, in passing, on 3 points the speakers made there. Let me say one thing more at the outset. My contribution to the collective work was focused merely on tokenized bank deposits. I therefore speak from inside the work of this group of colleagues, a few of whom are in this room. What I would like to do is to argue a thesis in continuity with our report, and I will suggest as a verification of its diagnostic anticipation. The report, as you all know, was finalized in January 2026 on the basis of an analysis that had been maturing throughout the previous year. The events of the months that followed have, in my reading, confirmed the timeliness of that diagnosis and made the architectural review it prescribes no longer postponable. With that said, the thesis I would like to defend today is our report rightly grounds the case for simplification in consideration of competitiveness, legal certainty, proportionality, and the integrity of the single market. As Ms. Donnery rightly emphasized yesterday, the European competitiveness challenge is itself principally structural, a matter of fragmentation and scale. I want to argue, and this is the central point here to me, there is a further structural dimension which is now functioning as a stress multiplier on that agenda, not as its driver, but as the factor that has made the architectural review, the report calls for an immediate priority rather than a medium-term program. The dimension is not, in the first instance, about time. It is about the adequacy of the legal toolkit. I stress this point. Categories, instruments, not only procedures, to phenomena whose structure is being transformed by technological innovation. In this perspective, simplification becomes a project of architectural recalibration and a precondition for systemic resilience. And the lawmaking process is the natural locus for that recalibration. Let me begin very, very simply just to put the stage on what I am saying. As many said, we identify complexity as a structural feature of EU financial regulation, not an accidental byproduct. And we anchor the analysis in the erosion of Lanfeus's hierarchy in the proliferation and hardening of soft law, in the multiplication of supervisory actors, and in the substantive fragmentation of definitions and taxonomies across regimes. We then propose a methodology in 3 steps: mapping rules against policy objectives, identifying overlaps and inefficiency, and submitting the architecture to coordinated evidence-based review. The empirical scale of this diagnosis was made vivid yesterday evening by Mr. Hager's figures. We have already mentioned, but I want to remind you, roughly 80 regulation directives, more than 750 level 2 acts with over 60,000 pages of annexes, between 780 100 level 3 requirements, and to take a single example, more than 2,300 Q&As on the European Banking Authority website addressing the capital requirements regulation directive. These numbers do not in themselves prove nothing, but they make tangible the structural condition that the report's methodology is designed to address. This diagnosis was finalized in January, as I said. I want to suggest that the months that have followed have provided an empirical confirmation of its timeliness, in a domain that the report did not need to address explicitly to be vindicated by it: the use of frontier artificial intelligence as a vector against the financial system. In November 2025, Anthropic publicly disclosed that the state-sponsored actor had used its Cloud Code model to infiltrate roughly 30 organizations, including financial institutions. A publicly attributed case of agentic AI deployed for cyber espionage, among the first reported at this scale. This disclosure does not stand alone. It sits within a now established body of public evaluative work, system cards published by the major frontier developers, evaluations by the UK and US AI safety institutes, and a growing peer-reviewed and preprint literature on agentic exploitation. They all document the marginal capability of frontier models to autonomously discover and exploit software vulnerabilities, moving along a steep curve. A leaked internal documentation surfaced in March 2026, reporting on a further generation of model, and this one further episode along that curve. So the evidentiary weight of which could be properly contestable, but the curve itself is not.
Filippo, may I kindly ask you?
Yeah?
Complete in 2 minutes.
Okay. So what technological innovation is making visible with growing intensity is therefore not the defect of the procedure, in my opinion, only. There is a problem of not to be faster, larger, more diffuse, but we have architectural conditions under which this kind of mismatch would emerge. To try to, in a couple of minutes, to say all I have prepared, I want to do directly to the example. Think of a tokenized bank deposit. Here is not a faster deposit. It is an object whose value is constituted on a distributed infrastructure, and whose integrity depends on the integrity of a protocol rather than on the books of a single institution. So you understand, okay, that this is a structural transformation. It's not a spatio-temporal one. The lawmaking process produces instruments whose legitimacy is constitutional, but whose categorical, as the two times that it happened in my panel, I don't know if what I'm saying or I don't know for that. Critical apparatus, sorry, because I want to stress this point, because at the end of the day, you understand that I want to mention one point from a public perspective. I'm a public legal scholar. And I want to stress this point because I think we are talking about old phenomena without considering the new one. So the problem is not only to simplify today, but to do that because otherwise we have problem to maintain a steady and financial market, the financial market stability. So I want to stress this point. I have many things to say. I have prepared and I have to cut, but
over time, people, please respect because we have people who need to leave.
Sorry for that. So I stop here. I have two proposals, but I remind to probably a EBI working paper. Thank you so much.
Fantastic. Thank you very much. Thank you, and apologies for being so strict, but we have to continue. It's with great pleasure to invite now Jonathan. Yeah, Jonathan over at Somnier. He's the acting executive director of the European Banking Institute, formerly European Banking Authority. Okay. Oh my God, I'm sorry.
I'm accumulating roles, that's fine.
And formerly head of the legal department there. You have been through the Lamfalussy process so many times. So please tell us what were our mistakes here in the discussion.
Well, first of all, thank you very much for inviting me to come and speak here today. I don't think I would dare criticise mistakes in the report. Indeed, reading it, it flagged many issues which are familiar to us. I think familiar to us all. Many issues which are long-standing ones. The Lamfalussy process, for example, what is level 1, 2, and 3, 4? What's the right balance? Goes back at least as far as the creation of the ESAs, and if not before that. So I would not propose to debate that this is a complex system that is becoming ever more complex, multi-layered. We started off with a system of complex institutional framework at individual national level. To that we added single EU bodies in 3 different sectors, plus the macroprudential authority. And since then we've added the SSM, the SRB, now AMLA, adding supervisory roles to individual ESAs, supervisory approaches that are different across the different sectors as well. So for example, the EBA under MiCA is only going to be supervising significant issuers of ARTs and EMTs, while ESMA has had supervision of all CRAs. Every edition is different for no doubt very good reasons, but it is undoubtedly complex. And the EBA has to accept that we're part of that complex situation. We may have added, perhaps unnecessarily, to the complexity. So rather than debate the existence of the complexity, I propose to say a bit about what we are trying to do about it at the EBA. Probably in October last year, we issued a little noticed report, I think. We're trying to publicise it rather more. And we set out 21 recommendations from our board about how the EBA should address this issue that we called the need for efficiency rather than simplicity, because we wanted to focus on it, as I think the report sets out and was, I think, broadly agreed last night as well. That this isn't about deregulation, it's about finding a way of achieving broadly the current level of regulation, for example, the current level of capital, to take a particular example, but to do so in a more efficient, simplified way. And that report, we set out 4 broad groups of actions that we felt that we could take. One on regulatory issues, one on reporting, one looking at the holistic picture of the framework as a whole, focusing on the banking sector for us, and then another on how the EBA itself kind of organises itself and what it focuses on. So going through one by one quickly, I'll try and rush through all 21 recommendations, but first of all was defining a methodology on what are the level 2 and 3 mandates that are material, which ones actually matter. The EBA has kind of been a taker of mandates. We in recent years have done, I think, relatively little own initiative guidelines, for example, because we have received so many mandates from the co-legislators, and we've taken those as the basis for our work programme, fulfilling our legal duty to supply draft technical standards, issue guidelines where level 1 requires that. But now we are questioning whether they're needed, and developed a methodology looking at, are they needed for supervisors? Are they needed for the industry in order for the EBA to achieve its objectives? And on that basis, last year we deprioritised 20%. That means deciding we're not going to deliver 20% of the mandates that the co-legislators have said are necessary for the EBA to deliver. That's looking at the kind of backlog of mandates that are to come. But taking a more active approach, we also are discussing with the co-legislators which of the proposed mandates in forthcoming legislation are needed. So PSD, PSR, there were 30 mandates given to the EBA. We suggested 12 of those actually weren't really a priority, and the Council and the Parliament happily agreed and has dropped them, enabling us to focus on what's really important. So there's a lot that we can do to not deliver on mandates that are assessed as not really being needed, and also to influence the legislative debate and avoid unnecessary mandates in the first place. That's more forward-looking. Longer term, we want to review all of our regulatory products. We've already started that, looking at some of the most complex on credit risk. Issued a consultation paper on that last year. Upcoming will be governance, remuneration, ESG, and also looking at supervisory and resolution processes. As part of that, also things like streamlining the stress test, changing how data is collected for that, so instead of every 2 years it's a new, different template, making it part of regulatory reporting, and using existing regulatory reporting where it's needed in order to stabilise things. On the what we publish on our website and how you identify what this enormous rulebook is, we already have our interactive single rulebook, and we're trying to see how we can make it more useful. There's some technical issues around that, but we want to make it more of a consolidated rulebook, which in the longer term also means, as part of this multi-layered framework, how do the competent authorities, whether at national level or the SRB or the SSM, how do they actually implement our guidelines, our technical standards in level 1? What is that extra layer that is added on to our products and to the co-legislators' products, and make that more visible? And I know that the SRB, the SSM are doing work to see to what extent the products that they've issued are needed, whether they can rely more directly on level 1, level 2, level 3 that already exist. Multiple recommendations on reporting, from having a much more integrated reporting framework, reducing the reporting burden by another 25% on top of the 20% that we reduced it by about 5 years ago, and a consultation paper issued a few weeks ago where we proposed removing around 50% of data points. So there's a lot of internal challenging going on what's really needed, what is the essential requirements that supervisors need to have in order for us all to do our jobs. That also means looking at what all the additional ad hoc data requests are. Internally, we now centralize any ad hoc data requests, so they go through a single, essentially a single team to make sure that we haven't already requested this data, that the EBA actually doesn't already have this data available to it somehow. And we plan to roll that out to competent authorities as well. So we'll have a repository of the data requests that are being made. So competent authorities can see what other data is available across the system and reduce the need for duplicative reporting requirements. And we want to make reporting more consistent in the sense of reducing the need for change management. So having reporting that's more stable over time, more predictable about when it's going to come in, and that takes us back to Professor Nasiata's comment about how is level 2 adopted. We're not fully in control of that process, and the timing is not always of our own making. On the holistic side, we're looking at things like the capital stack, again, for very good reasons. Capital requirements, liquidity requirements, plus the buffers, plus concepts like MDA, the systemic buffers, Pillar 2 requirements, Pillar 2 guidance have all been added on for good reasons over time. But much like the framework as a whole, it's time to look at whether that capital stack can be simplified. Has MDA, for example, worked in the way it was originally intended to? Perhaps it's one of these experiments that we can look back on and say, no, we need to move on and find a better way forward. On proportionality, CRR introduced the concept of small non-complex institutions, SNCI, but it's used in a patchwork way. Can it be made more systematic, potentially to the extent of giving rise effectively to a kind of small non-complex bank regime, or at least expand its use more consistently across the framework? Is it the right definition? Are there elements that we're missing? Should that in itself be simplified? Just have a clear size threshold, for example. It's all something that we're looking at to see how we can have a clearer system for everybody. Reflecting on existing home host responsibilities, use of waivers, also mentioned last night, in particular cross-border liquidity waivers, in theory available, in practice little granted. Seeing how we can harmonise key concepts. We've tackled in the past one of the points that's raised: what is a credit institution? What is accepting deposits? We've given opinions on it. Little effect so far in the legislative process, but who knows? Maybe change will come. We also want to tackle this multiple layers. We can't, with the EBA, we can't change everything. We have to work within the system that's been created so far, but recognise that there are these multiple layers. There are multiple supervisors, macroprudential authorities, resolution authorities, all working for good public objectives, but in a way which at least can be perceived and seems potentially uncoordinated. So we're experimenting, doing some pilot tests with individual banks, bringing together all these authorities and discussing with the banks the issues that they see and how we can set up potential supervisory, a wider form of supervisory college or platform or forum, which can try and bring all these public bodies together and see whether and how we can improve coordination and reduce some perceived overlaps or duplications or inconsistencies. There are other things the EBA can do as a kind of service provider to competent authorities, developing IT platforms for information sharing and supervisory coordination. We already have some, we can expand them further. With MiCA, for example, the EBA had to collect certain information, national competent authorities had to collect information, so we set up one platform. All information comes directly from the banks to the EBA, and then it's accessible for all those who are supposed to have it, replacing potentially 29 platforms with the ECB as well. We want to advise the Commission on where we think directly applicable rules can be better put in place, whether that's level 1 or level 2 delegated acts, technical standards, replacing things that are currently in directives. I read with a great deal of pleasure and was happy to hear Marco Lamandini speak at the EBA about Banca d'Italia's paper on replacing CRD and CRR with just having CRR. Why not? We have it with credit rating agencies. The argument, for the existing freedom of establishment treaty base is a kind of historic one. We should, in my personal view, move on from that. Absolutely. More on the holistic approach. We want to go beyond things like the capital stack, but also look at an impact assessment, potentially have a task for the EBA of looking every 3 to 5 years at the system as a whole, identifying what works, what doesn't, what needs to change. And then internally, we want to rebalance from being, I think, known as the rule maker and recognise that there are other tasks that we have, look more at supervisory convergence. To what extent can we look at things ex post and find how we can converge rather than harmonise through rulemaking, shift internal resources but also competent authority resources from happily providing people to attend working groups, standing committees to make rules, to working with the EBA to improve supervision in a way that doesn't mean imposing lots more rules. And that means having much more strategic guidance, another topic that was mentioned this morning. We face the same issue. If you bring together a group of technical people, that can lead to rules being seen as needed. Can we get more strategic guidance from our board to try and focus on what's really needed and then give clear instructions on where we need to focus the EBA's work? And work more closely, have that better dialogue between the technical level and the strategic level. And so it's a real pleasure to hear the thinking that actually we have a similar dynamic on the industry side, and perhaps we can move in tandem to improve that. So I wanted to add in that kind of more practical approach to what the EBA is trying to do to try and address some of the issues that we've been discussing here this morning. So thank you.
Thank you very much. Thank you very much, dear Jonathan. Jochen, you have the floor for 10 minutes. You see, I have to be strict. I make more enemies than I have done in the last 6 months.
I'm a little bit afraid now. So, welcome, ladies and gentlemen. Thank you for having me here today on this conference. I have a little bit the feeling as if I now look and present my view from the machine room. Yeah, obviously, as a partner from a law firm where we deal on a daily basis with financial services and have a cross-border network, truly cross-border network, we obviously see all these problems. And probably also my expectation is much lower than what we have heard today. I would be happy if we would already achieve small steps to make ultimately life for all those we live from ultimately. Zetzsche, you mentioned this today. We need profitable organizations, otherwise there won't be jobs for us and the others. So. From that perspective, I'm obviously a bit biased when it comes to simplicity because we've heard these are our mandates. Yeah, this is what we are working on, and I should probably mention in this context, I'm in particular active on the crypto and DLT side, and I will come to this and what this means from my perspective in a moment because it has a huge effect on the discussion I think that we have heard today. In my view, we are now coming to a situation, as I said, where banks and investment firms have super large departments, spend millions on implementation costs, and we have heard how many pieces of legislation they have to deal with, which in my view creates really a substantial risk for them, not only for, so to say, the perceptions in terms of investors, etc., but also a super large risk for them. And I can tell you from my own practice, we have just dealt with a case, for example, under the Transparency Directive, where, in my view, for mere formality of the regime, without any real effect on the market participant was fined by 1.7 million, and you see where the money then ultimately goes. I mean, ultimately repays this. I think it's important that we also discuss this enforcement process of the rules, and I have the feeling that the discretion that the national competent authorities have, in particular with regard to sanctions, is completely going into a wrong direction currently. And what I mean with this, to go back to this example, under the Transparency Directive, we have scenarios in one country where we end up with such an enormous fine. We have another EU country where the situation ends with an email. And this shows the extreme differences in the interpretation of the rules, although the Transparency Directive is meant to be a maximum harmonization directive. So my view to this would be, first of all, yes, we can complain about EU rules, but one thing that I particularly note, where we are I'm coming from Germany, from a highly regulated country, we need some harmonization. I use this term now explicitly, harmonization in terms of the interpretation, because we have the problem within the EU and we have the problem outside, so meaning in a global competition situation, and we need clarity on some aspects. And I do not say that we have the ultimate solution or the ultimate interpretation for something, but at least we should achieve something that is harmonized across the EU with one at least single understanding. That's, in my view, really something where we have to work on a little bit, or not a little bit, probably much more. The other point I would like to make is that from our experience, I often have the feeling that neither the EU side nor the national competent authorities are really aware of the implementation costs of some of these projects. And on the one hand, we're talking about new projects, so new rules coming in, but we are talking also about revising new rules. And to give you an example, I mean, we just started a discussion around a new nice guideline, which, so to say, replaces the current outsourcing regime. This will be the regime next to DORA, so everything that has to be outsourced will have to go into and be captured by this guideline. Positively, this guideline expresses at the beginning it should be aligned with the DORA structure in terms of databases, fields, etc. But when you then read through it, you find out this is a complete nightmare. You have to completely go through your complete group structure again, re-identify all outsourcing contracts, and put this into a new database. This costs millions. And I have the feeling when we read these kind of consultation draft, that no one is really looking what consequences it has. And the added value to this is quite minimal. I'm not saying here that we don't need a proper structure for documentation of outsourcing. In a certain way, this is there. And but what we have to start is really, and before even the draft goes out, thinking, what do we have collected already? And then put this together and then start thinking, do we have to put something additional on it? Or can we consolidate what we have already? And this has to be done on EU level, in my view, because we have 27 EU jurisdictions, and it cannot be expected that ultimately the players on the market develop an individual tool, an individual project, an individual employee group that just deals with these consequences, in my view. And it shows, I mean, you've mentioned this, the problem is really the nitty-gritties ultimately, where then there are differences in terms of EU perspective and the national competent authorities, and everyone wants to have his own role. In the meantime, I have the view, I don't care, to be honest, whether the data goes to the national competent authorities or whether it goes to the EU, unless one thing is clear, we send the same data, and there's a harmonized approach to this, and this requires a lot of work. And when you look into the DORA world, so to say, we saw there that at least the Excel tables, etc., and the data fields, etc., were there. But what happened then is that several national competent authorities put additional fields to the data fields that were required under the DORA regime, which then led to the consequence that for each country you have to develop a new project. No additional value. No additional value, zero, in my view. And to stick to the 10 minutes regime, I want to make one last comment. And Filippo, I think you went into this direction. We talked about yesterday about architecture, change of the architecture from the current regime. But my personal view is we are through the change of the landscape to the DLT regime, and this will come very quickly now. There will be extreme pressure on the market simply because the trading will be accelerated by a means we have not yet a clue of. I can give you examples. We have just tested this, where we just started a discussion now for 2-3 years, I think, to reduce the settlement cycle from 2 days to 1 day. We are talking about the settlement cycle of 7 minutes. Yeah? And this is something that we have to consider, because otherwise we are not able to control the risk anymore, not even the minimum. And this requires also a change in the attitude of regulators and how they regulate and supervise this. Otherwise, they will identify the risk when it's too late. Yeah? And this is something also we have to address, in my view. And I've held 2 years ago a presentation on compliance structures in light of this development, and it was quite interesting. The rule in the regime as such, to a large extent, still worked. But the way how regulators have to react and deal with this has to dramatically change. It turns the way around insofar as we discussed yesterday data delivery from the supervised party to the regulator. In my view, the data is there. Regulator, go there. You have access to it. It's not a problem. You can see everything. When you need the data, just go for it. You have anyway all rights. So that is something we should also have really on the radar. And so you see the machine room is slightly different from the academic approach, but obviously both is super closely linked to each other. And from that perspective, many thanks for your attention.
Thank you very much. Very constructive approach. We'll come back to some of these points, but not for the time being. Thomas, you are the one before the last, but not very, very least. Whatever you wish. But please, inside the room.
Okay, I'll try. So thank you very much. It's a great pleasure to be here, and it was a privilege to contribute to the EBI simplification report. I promise to keep it brief because I imagine everyone is very hungry at this point and quite melancholic. So I would just like to make one brief remark building on Filippo Annunziata's presentation on a point that is often overlooked, somewhat hidden dimension of the regulatory process, which is the judiciary and the role of the Court of Justice. Because of course, as also Dirk Zetzsche pointed, words do matter. Harmonization, for example, is a word that we employ often in regulation. And words are interpreted not only by market participants and supervisory authorities, but at the end of the day, the Court of Justice holds the last word on what these words mean. So my point is very, very almost redundant in the sense that we should consider case law whenever we wish to regulate. We should not ignore what has been established by the Court of Justice. And an example that I bring in this regard is the market integration package, which desires to assign to ESMA the role of applying national laws. Directly applying national laws. And this is a model that was built from the SSM regulation, Article 4, Paragraph 3, also now present in the AMLA regulation. And when referring to this new power that ESMA would have to apply national laws, it refers to the Corneli case. And it does so in a very matter-of-fact way. But in fact, Corneli is not a settled precedent of the Court of Justice. And we do have today different lines, different strains of precedents that lead to very different, and I mean very different conclusions on the outcomes of how this interpretation is actually going to be made. So just to briefly recap on this, the Corneli judgment basically says that national laws transposing directives should be applied in light of the wording of directives, of the objectives of the EU legislator. However, in a previous case, also by the Court of Justice, we had the Crédit Agricole case, which Gortsos commented in a very nice chapter, which basically says that whenever we have a national decision by a national court, we apply that decision. We must be deferent to the interpretation given by national law by a national court. And then we have on a very recent judgment, the Corneli, the Berlusconi II judgment of 2 years ago, which goes in a completely different direction and says that actually there are some concepts in EU directives, in the CRD, as a matter of fact, which are not to be transposed. We should not take into account what national legislation had made of that concept. We should actually consider those concepts as autonomous. So they are autonomous concepts of EU law. And therefore, Article 4, Paragraph 3 is completely disregarded in this sense, and also national law is completely disregarded in that sense. As a matter of fact, in Berlusconi, which concerned, to be clear, the acquisition of qualifying holdings in a bank, national laws aren't even mentioned in that decision. So to be very concise, I would just, again, restate my main point, that we need also that legislation takes into account how all of these classifications and definitions that we have established in directives and also regulations, how they will be interpreted and applied, not only by supervisors, but by courts, which are the last battle to be fought. And I believe this is something that, if done properly, would feed into a much more healthy regulatory process. So that's it. Thank you.
Thank you much. Thank you very much, dear Thomas. You are correct. This is the way that we should integrate the judiciary also into the whole discussion. And there is more into this, and we can discuss it. Milena, we started today with University of Luxembourg, and we end up with University of Luxembourg. Great pleasure.
The pleasure is mine, and thank you very much all for coming. Thank you very much for the opportunity to be part of this report, because for young scholars this is not very often the case. Let me begin by saying that this discussion is not only about how much law there is, because there is a lot of law here, but also what kind of lawmaking system the EU has created for itself. I think simplification also has to begin with return to basic principles in rulemaking, which is to start with objective or the idea behind a piece of legislation. So regulation is never objective-free. Usually there are always dominant goals, and usually there are several. They're not mutually exclusive, but they can be pulling in different directions. And this is where the problem starts. So the real challenge for lawmakers is not only to decide which objectives should prevail when there's a tension. And EU really cannot afford to make financial law as if every objective should be pursued with the same intensity at the same time. And the same logic applies to the competitiveness debate, or a potential new goal of lawmaking. So it is true that also that Union is increasingly under pressure to think about its place in a global system, and this doesn't mean that EU should just wait and see what others do, but should be aware of that. Let's take as an example sustainability agenda, CSRD and ESRS simplification. Before they were even tested in practice, it was obvious that they are too complex. But then instead of testing in practice and seeing what doesn't work, they were immediately simplified or very close to being deregulated. So now you have businesses who invested probably millions in compliance preparing for this, while now they're facing a situation where also market has created its expectations, but we don't know what will happen next. And even a few days ago, I heard rumors, and I think all of us have, that the EU is even considering abandoning ESRS and taking ISSB instead, which would be probably even more chaotic, even if appropriate, but at this point would create even more chaos. A second point, I think it has been addressed, but I'll just try to be very short, is the institutional setting and agencies creating even more law. So we mentioned level 2 and level 3 texts are increasing. Lawmaking is no longer thus concentrated in one place. It is distributed across the institutions, levels, instruments, and many of these, while being formally soft, they have a huge influence. So the point is not simply that ESAs are creating more documents. They will probably not stop if they are not tamed to do that and prevented. But this also changes the location of real norm taking, and a great deal is now of the effective content is no longer located in one place. So it's a set of instruments, it's many of which are formally not binding, yet in practice very influential. So I think, and to conclude with this, because I think everyone is impatient to go for a break, and I'm certainly happy to discuss anything further, that solution I think here is really go back to basics, not being scared of starting over and maybe even deregulating when appropriate. It shouldn't be avoided. So first identify the dominant objective, then identify instrument which serves that objective. So if it's soft law, fine, let it be soft law. Don't be scared of soft law. And keep the hierarchy of sources clear. Level 1 are principles. Level 2 adds technical detail when it should, but level 3 should remain properly bounded and transparent. Thank you very much.
Thank you very much, Milena. Thank you very much, all. We are on time. Before we give all our speakers the opportunity to make a final remark, I wonder whether there are any questions from the audience. Anybody who'd like to raise any point? You are not audience.
Okay, so you were joking. Okay, I thought so. No. Okay, so there's one question, and I find it interesting to hear Filippo A perspective. And Filippo A stated we should have a fast implementation, and I think you shared that view of level 2. Why don't we think the other way around? If level 1 is truly a principle, shouldn't then the supervisory authorities have time to gain experience and to develop knowledge where true guidance is necessary? Wouldn't it then be very disciplining for the regulator to refrain from level 2 until a certain number of cases has been on the table? Because then this is skillful regulation. Yeah, so I think principle level 1, like acting in the best interest of investors, and then we wait for 4 years. And then we have the cases, and then we regulate. Rather than regulating in the dark, we regulate with experience.
Yeah, until the angels govern this world, I think we will have to live with our level 2 framework. By the way, one point I would like to raise is the following. We continue going on this same discussion, yeah? We adopted the jargon level 1, level 2, level 3 from the Lamfalussy, correct? That was before the Treaty of Lisbon. And before the Treaty of Lisbon, we only had delegated powers given to the Commission. We didn't have the distinction between delegated acts and implementing acts. So as a matter of fact, the level 2 today is broader, correct? And it's different because Article 290 on the delegated acts and 291, they may look similar, but they are different animals, correct? So again, any proposal to be made should take into consideration how we intervene in the case of delegated acts, yeah, and the case of implementing acts, and if we were not to touch upon the treaty because we will not convene the Mykonos Treaty, yeah, or the Santorini Treaty, yeah, a nice place to gather and discuss for 10 years without concluding any treaty amendment, yeah, it's an excellent opportunity to go there. I do believe that we need to respect some rules relating to the delegation. That's another problem, another inherent problem. But what you mentioned before gave me a thought. Why not involve the ESAs even at level 1? I think
either, yeah, is this working? Yeah, okay. I think either you involve the SSS level 1 or you have a well-designed system of courts that enables this kind of experimentation and harmonization. Because currently what we have is a, court system with clay feet, if you will. So, yeah.
So we can play with different scenarios.
So just on that point about experimenting and waiting and seeing, I think one simple word change could resolve that. Instead of shall, may. So instead of the ESAs shall develop technical standards and the Commission shall adopt them, the ESAs may develop technical standards. But going back to 2010, the legal theory was, again, going back to Moroni, the ESAs shouldn't be given discretion on whether such rules do exist or not. The legislators have decided they shall exist, therefore the ESAs have to be told that we must write them. That's been breached a few times. And so maybe it's time to say, we may issue those technical standards. That then enables, well, it resolves this issue of level 1 coming into force before level 2. And then over time we can do peer reviews, we can do supervisory convergence work and see what's needed.
So maybe the next exercise by the EBI should be a commentary on Articles 289, 90, 91 of the treaty. Yeah? Or
you always think about new work. Huh? You always think about new work. The academic board is tired. We are exhausted.
My program is so empty so that I want to fill it in with new.
Now, on what Dirk was saying, points to something I've been thinking about a lot, because we lack empirical evidence as to how directives and regulations are applied across member states after. We do a lot of discussion beforehand, but then we sort of forget what happens next. And I think this is something that in the EBI we might develop, maybe in some areas, to really look at how, not how rules were drafted beforehand, but how they are applied concretely. And this goes to what you were saying, and about also adopting a comparative law methodology, because by comparing how things actually, not in theory, but in practice work in member states, how concrete problems are being solved by courts, by legal practice, by market operators, maybe we can understand whether we can move towards a common ground that works, because it's not placed on our heads with a top-down approach, but it will be bottom-up. So I agree with you. Let's wait, let's see, let's test, let's measure, and then let's complete legislation at whatever level you think of, whether it's 2 or 3 at that point, yeah.
And take a case study in what you mentioned before. Imagine of a delegated act, which is not rare, which is not a regulation, it is a directive. for example, the omnibus in MiFID. The omnibus. Correct? And then you have 27 versions of that as well. So the situation becomes even more complicated. It's not given that it's going to be a regulation. Yeah? It can be in the instrument of directive or regulation. The same applies to implementing acts, even though it's very rare that you have regulations, directives in implementing acts.
What Filippo said, there are also many examples where this already exists in the European Union. There existed a competition, private enforcement of competition law database. It was taken off the European Commission website. No one knows what happened. I emailed the European Commission. I'm sorry, we stopped. There are many databases also primarily in administrative law, how the Conseil d'État and the Raad van State, a similar organization, the European Union, how they apply European law and they send it towards the other national colleagues. We need that for capital markets regulation as well. We talk about the problems and the obstacles. There are many there. People are struggling with them. But many of the problems are very similar across member states. We need to understand how those obstacles are fixed. Maybe they aren't even obstacles. There are many private national law solutions to them. If there are solutions already to the problems, why harmonize further? Let's keep it that way. It's already functioning. But we are very much set in a mindset that divergence is an obstacle. It's not really an obstacle if the problem is not really there. It's only a difference in how people do things. These databases using AI, we heard some of the risks of AI, but AI can really also help us trying to gather these informations and also translate them automatically in a sort of a way that people understand them. So I think that's a very good idea.
Probably going back exactly to this point, I think we have to find a solution where things like, I'll give you an example, we just recently sent out a questionnaire regarding a tokenized financial instrument across the whole EU to receive an answer. Can we distribute it or not? Super simple question, you should think. The reality was that more or less from all EU jurisdictions, we received really responses which showed that there are fundamental differences. We are not talking about tiny little interpretation. We are talking about responses where it said, this is an AIFMD product, this is a fund, this is a MiCA product, this is a normal financial instrument, or this cannot be distributed at all. So we are not talking about something that is a small hurdle. Yeah? Yeah, absolutely. That's what I thought as well, but the reality is different. And this makes, in my view, or requires, in my view, that these obstacles, so to say, these interpretations and these differences are shown across the EU, so that ultimately one national competent authority sees also how others deal with it and come to at least something like a debate or discussion. We can then discuss whether this is a kind of home state-driven decision, so I register the product and now I can distribute it, or we shift it to the EU level. That's the alternative in my view. In my view, the EU side is the better one. Yeah? But the key problem for us is we are ultimately in a situation, I can give you precisely this example, where then the client decided, okay, EU is not the market we want to be in. Now we distribute our product outside the EU. So it has really practical consequences, and we are talking about loss of business here. Yeah.
And I think that you are pointing at something that perhaps I think needs re-emphasizing, that is because it's there in the report. So when we discuss the implications about simplification and we take a purely technical standpoint, one of the things that are suffering in the last years with the swiftness and the anxiety to produce is the conceptual clarity. Because if there is something that where the EU legislation could contribute, is clarity on concept. Now, you can get the concept right or wrong, and then you can change the concept, but at least if the concept is clear in the European legislation, then everyone knows what to expect. And that is one of the things where you don't need to wait until this is done by national courts. You can decide and wait on whether to impose more requirements or less requirements, to be more lenient, less lenient, but in defining what a thing is, in determining what the scope of application of a specific regulation is, then that is one of the benefits of having harmonized legislation.
Jokingly, but not only, speaking about clarity, take also into account the translation into the different languages. We are currently working on a mid-car project, on a commentary. And I'm reading German literature, among others, the one by Momme and yours and others. And I have realized that in particular there, when it comes to the liability of the issuers, there are differences in the translation in the German with English. So this adds to these problems. It was amazing. I realized it 2 weeks ago.
And it's amazing that that most of EU financial legislation is based on fundamental concepts and notions that have been there for decades, and we still don't know what we're talking about. Financial instruments. Fabian and I have complete opposite ideas on how to frame a definition, but both of our ideas might work in such an unclear environment. What is a credit institution? What is a deposit? What are funds? What is an investment fund? We don't really know. We know basically. So it's a castle built on sand, a giant with feet of clay. And when the Court of Justice, poor guys, come up with the Branelius decision 10 days ago, well, you realize we do have very serious problems. We realize that we have misinterpreting, or rather they are misinterpreting, but now the decision is there. It's a preliminary judgment. So what shall we do with that? Shall we simply forget it, pretend it does not exist? And we realize that for 30 years, 30, not 13, 30 years, we haven't understood what a price-sensitive information is. It's not trivial, right?
It can be worse, my friend. I got older when I fully understood what a credit institution means. Just to see the CRR, including in the definition of credit institution, also investment firms. Who now understand. I really don't understand what it is. For political reasons, apparently.
Any other remarks?
Any final comments from the speakers? So, you are the one before the last one.
Okay, and you are the last one.
I will reserve that to me,
Okay. So thanks everyone for being with us today. So first of all, I'd like to thank the organizers of the event for this. Of course, I'm part of those who speak and moderate and everything, but those who put the venue and put the funds are the ones really hosting us. So I'm immensely grateful. I'm also incredibly grateful to my colleagues at the EBI for being probably the best team that I have ever worked with. I think that when the idea of the report came from Christos and also from Filippo and from Thomas and Fabian and Milena, everyone immediately just rolled up their sleeves and started working. So being part of that process shows that how much people with different views, of course, because there were different views on many issues, can achieve together. So we managed to put together something that I think we are very proud of. We are not saying it's the last word, is not the beginning of the end. At least it's the end of the beginning. So everyone knows that we have to talk about this because a lot is at stake, right? So I think that on that note is that I offer my final remarks. So to just bring the point home, because sometimes we and not deal in abstractions, I'd like to bring up one case that we had at the appeal panel, well, several cases. We had to decide cases 221, 321, 122, 523. They all involved the same issue, which in principle, you wouldn't say it should be that controversial. It was an issue on the waiver of MREL requirements in groups, in banking groups. So there was a collision between the position of the agency, in this case the SRB, which considered that in order to waive, there had to be certain safeguards in place, notably a guarantee from parent companies in different cases, and the banks disputed that. Now, the case came in front of us, and we had to decide, of course, and you went to the provision. And it was Article 12H of the SRMR, and then there was also the reference to Article 45D, Section 3 of the BRRD. And the article said the board may waive MREL requirements. Now, if it said may in the United States, that would be the end of the discussion. Either I may, or either I waive, or I don't, and that's not something that should be up for discussion, legally speaking. But this is Europe, so there's a may, so there is a discussion. Of course, you have to discuss about this. But the plot thickens because the agency did not claim to be using full discretion, the may, but applying the requirements to exempt the parent company from this MREL requirement. So specifically, they said that they were applying the requirement under Section B of the provision that said that in case there are no legal or practical impediment to the prompt transfer of funds. So they interpreted this as if there is not a robust guarantee, there can be a legal or practical impediment for the prompt transfer of funds. So the whole discussion revolved around this. But I can tell you that we were looking into this, and we saw that the SRMR had 3 requirements. One of those was this one. The BRRD had 6 requirements, and we were trying to ask the parties, why do you think this is? And no one was able to produce a single answer. And these are 2 level 1 texts, one with 6 requirements, the other one with 3. They are supposed to be coherent, and they were not. So that was the first thing. The second thing was that the agency that was applying this decided not to exercise full discretion, although there was a may in the provision. They decided to apply the more technical provision because they thought they were on safer ground. In third place, the discussion should have revolved around how robust the guarantee was, which is a matter of national private law, but everyone sort of more or less dodged the question, even though we insisted upon this. There was no convincing argument as to how robust this is under private law. And all this discussion focused around all these issues because there was another requirement that was contained in letter A of the provision that the parent and the subsidiary have to be in the same member state. And that was not something we could question. It is a level 1 text. So what are the conclusions that I draw from this? And this brings me to some of the lessons that are also on the report. First of all, I don't think that we have learned to think, we don't have the right mindset to think about uncertainty. We are used to think about risk, probabilities, but we are not used to think about uncertainty. When we don't have historical data to project how an event may play out, we don't know how to think about this. We have to accept that we don't know. And we end up designing regulations for different scenarios that may materialize or not. And therefore, since there is no historical data, there is no need to prove that they are probable. You have to accept them as plausible. But since we have so many regulations with so many rules, with so many scenarios, we end up having an overloading of scenarios that hinders the possibility of any activity. So that's one of the lessons that I drew, because in the end, if the test is one of plausibility and not probability, then it is much harder to dispute that a rule or a decision has to be in place. But uncertainty pervades the whole political process. I'm not blaming the agencies. I'm not even blaming the Commission. I think that the legislators feel that they have to react to something that is perceived anxiously by their constituencies, and then they produce a legislation that basically doesn't know, but thinks about this scenario, and this scenario as catastrophic, and to be avoided at all costs, even though we don't know whether the scenarios would be catastrophic. The third aspect that this brought home to me was that you end up with a system that, since the choices are not clear, because they are brought on by uncertainty, you end up with a process of application that is deliberately designed to diffuse any responsibility. So I think that I know people incredibly competent at the ESAs, at the Commission, also at the Parliament, but the whole system is designed to say everyone's to blame, so no one is to blame, because there's the national authorities, European authorities, then there are the treaty institutions, and so on. So we have no one to blame in the end, and that's another of the difficulties. And finally, all this discussion about how we produce norms takes the focus out of two things that I think are essential: how the norms are applied, what the role of courts has been. I think the issue has been brought up like 4, 5, 6 times during this, and we don't pay enough attention to this. We don't pay enough attention as to how private law courts apply this, or public law courts apply this, and how provisions are enforced. But we also take our focus out of something that is fundamental, which is the single market. I think that we have to make a little bit of self-criticism, because for the past years, since the crisis, we have been focusing on putting out fires and then preventing fires, and then thinking about possible fires to prevent them in the first place, and a little bit of focus has been taken out from the single market. So the single market may be the single best political achievement in terms of peace and prosperity, not only for this region, but arguably one of the world's best achievements, and to a certain extent is now put on a level with other goals that may be equally important or perhaps less so. So in terms of my remarks or how to go from here, one, demand explicit choices from the co-legislators, and if there is no consensus, more candid recitals. We could not reach a consensus, so we left this open. So that's a perfectly valid, a much better alternative than what we have, which is very long rules with very vague provisions. 2, put the single market back in the top place. So harmonize in order to achieve the single market, not the other way around. And then, of course, yes, 3, streamline structures at the ESAs, SSM, vest them with powers. Vest them with powers. I think that way we would have someone to blame if something goes wrong. But now we don't have anyone to blame. And 4th, please focus on enforcement and how norms are applied. We have talked a lot about the Lamfalussy architecture, level 1, level 2, level 3. I should remind everyone there was a level 4, which was about enforcement, especially by the Commission, when someone is applying norms wrong. And there are many people applying norms wrong, and they are not sufficiently corrected. So in that sense, those would be my conclusive remarks, and I leave the floor to Christos so that he, which has been the soul of this project, can close the event. Christos, thank you very much.
Thank you very much, dear David, and thank you for having moderated this excellent day with me. Yeah, I think we had a great day. What I keep from our report and from our discussions are 3 points. Point number 1, we have raised that in the report, but we didn't even mention it today. But to me, it's very important, and this is legal certainty. Yeah, the fact that we have rules changing every 6 months is not compatible with what we learn at law schools. Yeah, that when you set up business, you need to know what rules you have to comply with. And we have a table where we have mentioned how many times the CRR 19 times, the MiFID 12 times, I don't know who else, have been amended. And we mentioned, with the exception of the SSMR, yes, of course, because there is a unanimity, and the Deposit Guarantee Schemes Directive, and now we are wrong because the Deposit Guarantee Schemes Directive has been amended. Yeah? Legal certainty is something that we need to take into consideration. Yes, we need to adapt. There are new rules at international level. Yeah, the BRRD and the SRMR2 were byproducts of the FSF. The CRR is amending according to the international financial standards. But still, some kind of regulatory pause at a certain point of time might be necessary, also in terms of absorbing all what we have legislated, yeah? Because at the end of the day, the question that comes again and again is, well, we have these rules. Who does comply with them, yeah? And who is in a position to fully supervise, yeah, and check whether the regulatees are complying with the rules. I very much doubt whether this is the case. I have no reason to doubt it, but I very much doubt it at the same time. Yeah? I have no evidence on this. You have overregulation, this is given. We have accumulated policy objectives, well beyond financial stability. Yeah, we can list them. And the joke goes, yes, we need financial stability. Yes, we need investor protection. Yes, we need market integrity. Yes, we need environmental protection. And at the end of the day, who is going to make money? Yeah, because this is a key concern. You may achieve all the objectives, but at the end of the day, there will not be any business case. I don't know, just a warning. I have a personal experience. Most of you know that I have completed last year a 2 volumes banking regulation handbook. It may not be the best or definitely not the worst, but still it's a good book. Yeah. When I started writing that, the first volume, I sent for comments to some of my dear friends here, and Filippo reacted. He said, first, I will never forget it. Yeah. Do you understand, my friend, what you are doing to yourself? Huh? He was correct. Volume 1 was published in 2023. It's already outdated. Volume 2 was published last year. It's already outdated. I don't even dare distribute to my students in Luxembourg Volume 1, especially the international part. I'm distributing updated notes. So that means that we have over-regulation, and at the same time, we have a moving target. And this is not good in terms of legal certainty and business-friendly. I understand that we are still the victims of a huge crisis, yeah? And we know that in most cases, not always, rules are children of crisis. New rules, new institutions are children of crisis. It takes a crisis, and the global financial crisis has left a huge footprint on this. And then the fiscal crisis in the euro area, starting from Greece. So overall, we have tried, I think very diligently, to set up the scene, yeah? And today, to discuss it further. Thank you again very much, all those who have contributed to this book. Yeah. Thank you very much to the Supervisory Board of the EBI, because they gave us the incentive. Yeah. It was a meeting that you had with the European Commission almost 1 year ago, and then you gave me a call. And you asked me whether we can do it, and we delivered. Yeah, in 8 months' time, we managed to deliver with a very good help from our young researchers, but also, yeah, afterwards, with so many comments by you, David, yeah, by you, dear Bart. Filippo, you underestimate your contribution. Yes, what was included was this example on the tokenized deposits, yeah, but you contributed more than that. All those who contributed, thank you very much. Thank you very much to the Secretariat of the EBI always for all the help. Andreas and your team, thank you again. I mentioned that today at the beginning. It's incredible what you have done here. Yeah, everything was perfect. So a big applause to you, and thank you very much. Thank you, Jonathan, for coming, and have a nice trip back. Thank you all, and hope to see you again soon in one of our events. Thank you.